Welcome, everyone, to part 2 of tax law changes related to the coronavirus pandemic. This is sponsored by the Virginia Society of Enrolled Agents, and we are so grateful for their leadership in this. And the CPE today is provided by Tax Practice Pro, and so we are grateful for that. If you're looking for IRS CPE, that will come from the Virginia Society of Enrolled Agents. If you're looking for NASBA CPE, that will come from Tax Practice Pro. In both cases, that will come out as we can get to it. It will not be today. I think I probably had 500 to 600 emails to me personally last week asking me, how do I get my CE or CPE? Trust me, they're working on it. It's coming. Don't feel like you have to email me because, frankly, I'm not the one doing it. So if you have problems, seriously, you can email me. It's fine. But be aware that it may take a week or two before we get all of that handled. There are a lot of people here. If you're looking for the handouts, simply click on the Handouts tab in the upper right. You will see 2 handouts there today. The first handouts, part 2, is the big packet. So that's the one that shows all of the full page slides so that you can easily read it, as well as the other handouts that are in there. If you open that PDF, it does have bookmarks in it. I do not encourage you to print that whole thing. I do encourage you to open it, look at the bookmarks, and see what is there, and you can refer to that as a reference. The one that you may want to print is the one that is called Slides with Notes. That, and it puts the slides 3 to a sheet and has a space for notes on the right. And if you want to go ahead and download that and print that now, you are certainly welcome. Some people like that, some people don't. So we give it to you both ways. In the handouts, you get the full sheet, and in the slides with notes, you get the other. So that way you can reach everything that is there. The handouts tab should not be blank. Somebody let me know that they are seeing the handouts. When I click on handouts, they are definitely there. So somebody let me know that you're able to see all of the handouts. And you dig my Yeti mic. Thank you, Roxana. Someone knows their microphones. All right. So if you don't see the handouts, some people see them. So that means that they are there. So if you don't see them, simply refresh your screen and then click on handouts in the right-hand side. And worst case scenario, you get to email me afterwards, like about 100 people did last week, and I will personally email you the handouts. That is the advantage of all of the emails coming from me, is that they come back to me. So, all right, lots of people are seeing the handouts. Fantastic. We are so glad that you're with us. We're going to go ahead and get started. But before we get started, I want to give the president of the Virginia Society of Enrolled Agents, who is hosting us today, Tanisha Gaines, an opportunity to welcome you.
Good afternoon, everyone, and thanks for coming. My name is Ty Gaines, and I am the president of the Virginia Society of Enrolled Agents. I know this is a very tough time for everyone right now. I feel like my head is about to explode. We have a lot of information for you today. I would ask that you hold off on the questions and let us get through most of the slides, because there are so many people on here that we can't answer the questions as fast as they come in, and most of it will probably be covered in the seminar. So just give us a minute with that. I do want to say that historically, EAs have a history of helping America in times of crisis. The EA designation dates back to right after the Civil War, when questionable claims were being presented for Civil War losses. So Congress started regulating who could represent citizens in their dealings with the U.S. Treasury. And it looks like all of that is coming full circle to us today, as we have to wade through these waters and try to figure out what is meant and interpreted by all of the things that have just been passed by Congress recently. The Virginia Society of Enrolled Agents has a very active board, and we are very involved with our state and federal legislators, and we stay on top of most of the information as it comes in and comes out and changes every day. We're also very involved with our local state tax departments as well, North Carolina, Maryland, DC. We keep up with those things, and we are here today with some of the things we have compiled for you, and hope that you will take it all in and try to process it at some later date. But I can say that we have 2 of the smartest people I know on this webinar, and they have spent an enormous amount of time trying to get this information together, and have sent me numerous emails, texts as we walk through this process. So we've put this together for you today. We hope you enjoy it. And with that, I'm going to pass it off to my other two board members, Knox Wimberly of Knox Taxes in Bradford, Virginia, and Vaughn Long of Tax Solutions Alliance in Chesterfield, Virginia. Take it away, guys.
Knox, go ahead. You share first.
Go ahead, Vaughn. You're actually.
Now, this will be straightforward to everybody today. We've got a lot of things to cover in the CARES Act. Knox and I have kind of split this up along the way. I know there was a question about asking about how the SBA impacts these different loans. I will be covering that, and I'm sure Knox will be chiming in on that as well. So, Knox, I think we're ready to get rolling. We got a lot to cover.
All right, here comes your PowerPoint, Vaughn. Sorry about that. I just realized I hadn't even shared it yet, so that was a bad knock.
I was waiting for it.
All right. So real quickly, our objectives today, we're going to talk about Notice 2020-20. And to do so, we're going to review 2020-18 really briefly that we touched on last week. Then we're going to deal with what I call the great press release flip-flop. And some of you know what I'm talking about and are probably laughing right now, but we'll discover what that is for those of you that don't know what I'm talking about yet. And then we're going to briefly do a review of the Families First Coronavirus Response Act, and particularly the things that have been updated since we spoke a week ago. So we'll be looking at the Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Expansion Act that are a part of that. Then we're going to look at the CARES Act, and we're going to break this into like individual provisions and then business provisions. So that's kind of the way we're going to break that up. But we're also going to deal with Notice 2021 and Form 7200, as well as Notice 20-22. So inside of the CARES Act, we're going to deal with the recovery rebate that all of us are receiving phone calls about and questions from our clients and from our friends. And then we'll also be looking at the other individual provisions. We'll go into more of what those are. But in terms of the business provisions, we're going to be looking at multiple options here for how you can actually get your clients help with liquidity, and particularly with payroll and some other things. So we'll talk more about that. But we're going to look at the employee retention credit. We're going to look at the payroll protection program. We're going to look at the emergency disaster loan. We're going to look at the emergency disaster grant. We're going to look at our net operating losses. You say, wait a second, there are net operating loss issues inside of the CARES Act? You betcha. We're going to look at AMT issues. Wait a second, Knox, there are alternative minimum tax issues inside of the CARES Act? Yes. We're going to deal with jail in Section 163. If you don't know what I'm talking about, we're just dealing with business interest limitations. And so we're going to look at that. And then we're also going to look at QIP, or Qualified Improvement Property. So that's kind of our agenda today. Lots to cover. I want to encourage you, as Ty did, don't ask a question if it relates to one of these until we cover it. Then ask the question. That way you're not asking questions for things that we are about to cover. But if after we cover it, you still have questions, go ahead and put those questions in. Absolutely. So that's kind of what we want you to do there. Real briefly, Notice 2020-18 does supersede 17. It expanded on the relief of 17. And as a reminder, it defined an affected taxpayer as any person that has a federal income tax payment or federal income tax return that is due on April 15. So that person can be an individual, a trust, an estate, a partnership, an association, a company, or a corporation. And the due date is now moved for both filing and payments to July 15 for those that were due on April 15 and were included. But you may notice that even though it removed the limitations of 17, it included the estimated income tax payments that were due on April 15, but it did not include our Q2 estimated income tax payments. And so that means that we still have a June 15 deadline for those. It did explicitly exclude information returns, so we need to be aware of that. And then we need to be aware that it moves the interest and the penalty so that those don't start until July 16th or after the July 15 deadline. This is an automatic extension. Don't have to file a 7004. Don't have to file a 4868. And you will recall that not only did I mention the Q2 estimated payments last time, as I just did, but I also mentioned something else, and that is that the March 16, which is normally 15, but that was a Sunday this year, those forms were not extended. And so you need to be aware that those were still due, and if you're still holding those, you need to get those in, because those penalties tend to be monthly for most of those forms. The fiscal year taxpayers with returns due April 15 are included, but returns due May 15 are not. So think about your 990s that may be due in May. Those are not going to be included, as well as any fiscal year returns that are on that date. And then payroll and excise taxes are not included. And in Notice 2020-18, I pointed out to you last week that estate and gift tax returns were not included, nor were GST or generation skipping tax. These items were not included. And I said, pay attention. This is something that I don't think was an intended consequence. Well, somebody else thought that too, because the IRS actually fixed this in Notice 2020-20. And so now we have a situation where even those items that are on the Form 709 are going to move. So I did include these slides once again, telling people how to move their payments, because I'm still seeing questions about that. I'm not going to go over it again, but it is in your material. So that is there. Somebody asked a question in the Q&A or the chat asking about RSEDS, the refund statute. Is that going to move? The answer to that is no. This does not move the refund statute in any way. So Notice 2020, once again, it simply adds Form 709, which is the United States Gift and Generation Skipping Transfer Tax Return. With that, we're going to go ahead and launch our first polling question of the day. I want to remind everyone that you need to answer at least 8 of the 10 polling questions today in order to get credit for today. That is whether you need IRS CE or NASBA CPE. In either case, you need to answer 8 of the 10 polling questions, and you need to be present with us for at least 100 minutes. This should not be a hard question. The question simply, my knowledge level on these topics coming into today's webinar is nada, low, medium, high, or move over, Knox and Vaughn. I could teach this class. So let us know what your knowledge level coming into today is. That would be helpful to us. And we will close this poll in another few moments or another few seconds. I think we've got 975 of you who have answered. We are over 1,000. I'm going to give you 10 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. And that poll is closed. It looks like 2/3 of us are in the medium knowledge level, which probably means you've attended a few webinars this week. About 1/4 of us are in the low. And there are 7 people on this webinar who say, get out of the way, Knox. I could teach this thing. So weird. Oh, did you answer that way, Vaughn? Yeah, that's good. All right. So maybe 6 others. And Ty might have answered that too. So Lori's asking a question. Is the due date for Form 10 or Form 990 on May 15 extended? The answer to that is no. It has not been extended. So back to our material. We're going to talk about the great press release flip-flop. So this was interesting because the law is clear on its intent. Congress was very, very clear. They do not intend for persons who are on Social Security or railroad retirement benefits to have to file a return in order to get the stimulus money, that the IRS was to get that information from the RRB or the SSA, as the case may be. However, the IRS issued a press release on March 31st, and that was 2020-61, saying that they would have to file. Answering the question in the FAQ, I'm not typically required to file a return. Can I still receive my payment? With yes, people who typically do not file a tax return will need to file a simple return in order to receive an economic income payment, and included senior citizens and Social Security recipients into this list. And a lot of us went, what? That doesn't make any sense whatsoever, and was clearly not congressional intent. Some practitioners began filing returns that did not need to be filed. Some CE and CPE instructors were telling practitioners to do so. I heard a CPE instructor who I will not call out by name yesterday rail on for 20 minutes about how we needed to file these things. And someone said, well, the software won't file a 0. Well, put a 1. Go do free file, paper file, do something. And I thought, please move over, idiot, but I won't call her name. Anyhow, several members of Congress got involved, and the good news is that the IRS issued a new press release on April 1st. That was yesterday, and you do not have to do this. So do not rush out there. Do not go file pointless returns for persons that otherwise do not meet the filing threshold just because of this. That is not Congress's intention. And the IRS has now said, and this is a direct quote from the Secretary of the Treasury, Social Security recipients who are not typically required to file a tax return do not need to take an action and will receive their payment directly to their bank account. So I just wanted to clarify that real quick. We are going to go ahead and throw up our second polling question of the day. We're going to get our second one out here pretty early. This one is another easy one. What credential do you hold? And you can select all that apply here before you hit submit. So we will give you just a moment to do that. Are you a CPA? Are you a CFP, an EA, an attorney? None of the above, but an annual filing season program participant, or none of the above. We'll give you just a moment to answer that, and then we'll be right back to our material. Lee, I'm glad that was helpful to you. Glad that was helpful. At least you got your bang for your buck today, right? On a free webinar, you at least got value out of your time. So that's good. We do have a few questions that are coming into the Q&A, and Ty will be answering some of those as she can. The ones that don't easily get answered by text, she will save for us, and we will answer at the end. All right, let's look at how we're doing on the poll, and it looks like we are at about 1,040 responses. I will give you 5 seconds. 5, 4, 3, 2, 1, and I am closing the poll. We are 57% EAs today, about 25% CPAs, and then a smorgasbord of the above. And since we are sponsored today by the Virginia Society of Enrolled Agents, I am not surprised to see more EAs today. So good. Welcome to all of you, though. We are glad that you are here. If you missed one of the polls, don't worry about it, because you only have to answer 8 of 10. Just make sure you answer as many as you possibly can. All right, quick review on the Families First Coronavirus Response Act, and we are not going to go through the whole thing in depth. I did include the more slides than I'm going to show today in your material. So if you're looking at it and trying to flip through, don't get confused. I'm going to skip some, but it's just because of time. So there are 2 tax-related bills that are contained within, and the first deals with the Emergency Family and Medical Leave Expansion Act. The second deals with the Emergency Paid Sick Leave Act. And then, of course, it's the tax credits that are in Division G. But I need to point this out because we didn't have this last week. There is a poster that the Department of Labor has issued, and you are required to post this poster. I have included a PDF of the poster in your handouts. Again, open the PDF of your handouts, open up the bookmarks, and you can click right on it. But I've included this poster in your handouts. You are required to post this. Some of you are going to say, well, Knox, normally I would post things in a break room, but none of my people are at work. What do I do? You still post it in your break room. That's part A, assuming you are able to go there. If you're homebound and nobody's going in, then you don't worry about that. But if you have people who are working remotely, you have to email it to them. So just simply email them the PDF to all of your staff, and you will have met the guidelines in this current environment. So it is important, though, that all of your employees have an opportunity to see this poster. That is a requirement from the Department of Labor. So be aware that that is important. Do not skip over it. All right, real quickly on the Emergency Paid Sick Leave Act. This is provided because you yourself have issues or because someone that you take care of has issues, and it is available for 2 weeks. Again, not going into those details. We did that last week. But what about persons that have a PEO or some kind of multi-employer bargaining agreement? Those are included, not a problem. The effective date is April 1. Now, some of you say, wait a second, Knox, last week you said April 2. That's because that's what the act said. But it actually said up to the secretary or April 2nd. So the secretary could do earlier than that, and the secretaries did agree to do April 1, which makes a lot of sense, actually, to start it with the quarter and with the month. So it's going to be April 1, which means this went into effect yesterday. All right, employers, you have to remember that this is only available for those with less than 500 employees that employ one or more employees. So somewhere between 1 and 500, you are good to go. And if they are on that first set, which is paragraph 1, 2, or 3, those are the ones that relate to me personally. I got sick. I can't, those sorts of things that relate to me. That's 511 a day times 10 days could be 5110, and that is up to that amount, not to exceed that amount. Paragraph 4, 5, and 6 is 200 a day. So this is when I take care of someone else. The most frequent one is my kid is out of school and I'm unable to work. But remember that there is a telework clause in here. We talked more about that last week, so I'm not going to go into all of those details. Now, the Emergency Family and Medical Leave Expansion Act, the first 10 days are not covered, but it can be dovetailed with the Paid Sick Leave Act that we just talked about. So the paid sick leave can take care of those first 10 days, and then the next 10 weeks, for a total of 12 weeks, are covered here by the Emergency Family and Medical Leave Expansion Act, or up to that. But this act is only triggered when we're dealing with someone who is out of school or childcare issues. And so we need to be aware of that. And this one does not exceed 200 per day. But again, this can get up to 10,000 per employee in the aggregate. It's a lot of money. The good news is that the feds have a way of paying for that, and there are some calculations for part-timers. Not going to go into that today. Again, remember that there are labor law issues, and so you may need to consult a labor law attorney if you are looking to get rid of people in any way. Now, if you're just keeping them and paying them under this act, you're not getting rid of them. You are good to go. But there is something called the WARN Act. I'm not an attorney, so I'm not going to go into it. I'm just cautioning you that before you lay people off, you need to be aware of the law. And so consult an employment attorney if you are in that situation or considering that situation before you take action. All right, what is this triggered by? Like I said, it is your inability to work or telework because you are caring for someone, meaning your child or your dependent, who is under 18 years of age and their school or childcare facility has been closed due to what is happening here. For example, in Virginia, where I live, all of the schools are closed for the rest of the year. And so there could be people that qualify here if they're unable to telework. All right, again, effective date is April the 1st, and PEOs are included for this as well. Our tax credits show up in Division G, and these are done in payroll tax credits. So there's a payroll credit for the sick leave, there's a payroll credit for the family leave, and it is applied to wages from April 1 through December 30. 100% of the qualified wages are paid, plus a pro rata share of the qualified health plan expenses, and it is refundable if it exceeds the payroll tax liability. And this actually gets a little better. We're going to talk about that in just a minute, but we've had some administrative action which sweetens the pot after a result of the CARES Act. And so we'll talk about that. So tax credits for these persons are also available to self-employed individuals, but in this case, it's going to apply against Schedule SE or against the self-employment tax. Basically the same calculations, except it's going to go back over. Anyway, you've got it in your material. I went over it last week. I'm not going to overly go over it now, other than to say it's in your material and it does apply. We're going to go ahead and launch our next polling question. And I know I'm flying through this first part. The reason that I'm flying through this first part is it was largely covered last week, but I am going over some of the new material that is there. Next poll, I need to rush out and help seniors file tax returns that otherwise do not have a filing requirement so that they can get a stimulus check. True or false? And we'll give you just a moment to answer that one.
Knox, while we wait for that question, one question I want to hit on that came up early on, that is, we're not going to be talking too much about IRS collections today. Question is, are IRS collection actions suspended? Does that mean the CSED is also being told, the collection statute? Benjamin, I've heard nothing to say that the collection statutes are being told. They are, as far as I know, still running. There have been no announcements one way or the other about that, Knox, unless you've heard something different. It's my indication they are still running.
Yeah, they are still running. There was a notice that came out and basically said, we are encouraging you all to participate with us on extending those statutes when we ask you to. And that was pretty much the word. We are encouraging you to do so. So that is the official word that has come out. So short answer is no, those are not legally extended. So those are statutory, and they will be asking you, ROs will likely be asking you to extend those statutes. And of course, as is always the case, when you get asked that, you need to weigh the particular facts and circumstances in that case. But I will tell you that I do not universally do that personally, just because they ask. Different people may have a different answer, but I have on occasion. So again, you need to look at the facts and circumstances in a particular case as to what makes sense. All right, we have about 1,100 responses here. We're going to go ahead and close in 5, 4, 3, 2, 1. 96% of you got that correct. You do not need to go rush out and file those tax returns for your seniors. So good job there. All right, we're going to look at Notice 2020-21. And this is the notice that actually set the act that we were just talking about, the Families First Coronavirus Response Act, to April the 1st. So remember that last week I told you it had to be April 2nd or sooner. It was set to April the 1st. It's going to end on December the 31st, and that was a coordinated decision between the Secretary of the Treasury and the Secretary of Labor. So this does apply to refundable tax credits for employers, as well as self-employment tax credit. Those are going to be the effective dates there. We also got a brand new form this week, or at least the draft of it, and it's Form 7200. And this is the advanced payment of employer credits due to COVID-19. So you may recall that last week I told you that there was a provision in the law where if you were under a certain small employer amount, that you could potentially petition to the Department of Labor to be excluded. And I told you that it was my opinion they do not want to do that, and they're going to do everything they can to get you the money quickly so that that is not a reality. But they're not going to do that for anybody, is the short answer, because they have decided they're going to advance these credits to you if you need it. And so that's what this Form 7200 is all about. And if you cannot reduce your employment tax deposits to fully account for the credits in that quarter, remember I told you that they are refundable under the Families First Coronavirus. Well, actually, the CARES Act, a new provision, says that they can advance these. And so this is a response to that, and they will be actually advancing these credits. I am told that when the 7200 is filed, you will receive those funds ACH'd to you within 2 weeks so that you can use those funds to pay your employees. So fantastic news there, I think. But obviously, you're not able to double dip here. So you can't file the 7200 and also file for a refundable credit on the 941. I mean, this is a duh, right? So again, the IRS is saying they're going to pay these 2 weeks from the filing. Hopefully that will be the reality. So Notice 2020-22 gives us a relief from the penalty for failure to deposit employment taxes. So they're actually also saying now that you can reduce without penalty from paying those taxes to begin with, so that you can use those funds to pay these different provisions. And so that is good news as well. So those two notices kind of go together along with Form 7200, Notice 2020-21 and 2020-22, and Form 7200. Again, those kind of all work together and are in response to some corrections that came out in the CARES Act. Speaking of the CARES Act, what is it? Well, it's the Coronavirus Aid, Relief, and Economic Security Act. It's a little bit of a beast. It is commonly called the CARES Act. So if you didn't know the official name, now you know it. There has been lots of confusion on this bill. And I have to chuckle because lots of CE providers and lots of CPE providers have gotten this wrong in many cases. So big question, right? Was it the Senate version or the House version? Kind of a trick question. Was it 880 pages or was it 335 pages? Most of you have heard that it's 880 pages, and that is the wrong answer. The final answer is that it was the House Bill 748. However, it was almost completely amended by the Senate. So it's all the guts of the Senate bill, but they actually did it by amendment, and it came into the House bill. So the Senate bill was 880 pages, and I can't tell you how many CE providers and CPE providers have read that 880-page bill and taught from that, when the law is actually 335 pages. Do you think there might be some differences? Well, of course there are. The law, however, was signed by the president on May 27th. If you want to go look this up, it is Public Law number 116-136. And I knew that someone here is going to say, no, Knox, you got to be wrong. So I included it in your handouts. And so not the whole law, but a couple of printouts that will prove to you that I am right about this. And so if you look at your bookmarks, you will find that in your handouts as well. Lots and lots of confusion about this. And I have heard some people downright teaching the wrong stuff. And it's not because they were ill-intentioned. It's simply because either they decided to teach it before the law passed, which in my opinion is 100% of the time a bad idea, or they simply didn't understand what actually happened. So key provisions for us as tax professionals, and we need to be aware of this. First of all, Section 1102 is the Paycheck Protection Program. This is a biggie, maybe the biggest thing in the entire act that you need to understand and will help your clients to be able to make payroll, some of you as well. Section 1106 is loan forgiveness, which goes hand in hand. Section 1110 is the emergency disaster grants. Section 1112 is a subsidy for certain loan payments. Sections 2102 through 2116 deal with unemployment assistance, and I saw a couple of questions about that. I am going to touch on that briefly. Recovery rebates for individuals is in Section 2201. Section 2202 is the use of retirement funds. 2203 is the waiver of the RMD rules, the required minimum distribution. Section 2204 gives us a partial above-the-line charitable contribution deduction. We'll talk more about that. And the charitable contribution limits are increased in Section 2205. In addition, we also have a whole bunch of business things to be aware of, such as in Section 2206, employer payments of student loans, Section 2301, an employee retention credit, 2302, delay of payment of employment payroll, 2303, modifications of our net operating losses, 2304, the modification on limitation of losses, 2305, our AMT modifications, 2306, our business interest modifications, 2307, the technical fix for QIP. Yay, we've been waiting on that. In sections 3601 through 3611, technical corrections that were related to the Families First Coronavirus Response Act. So I give you all of that. That's in your handout so that you can know where to go in the law and look for the particular things you need to look for. With that, I'm going to actually turn it over to Vaughn, who's going to talk some about the recovery rebate. Vaughn?
All right, we're going to go deep dive into these checks. There are lots of questions out there. Of course, Knox hit on the fact of the filing returns with Social Security. You'll see this in the slides because we wrote these separately over the last couple of days. So we're going to go through that, make sure we answer all the questions we can on it. And I know we're already 40 minutes in, so we're going to get rolling on this. All right, high level. I think we've all heard the amounts, right? Single is $1,200. Married filing joint is $2,400. Head of a household is $1,200. And depending on your 18 and your 19 return. So that's only direction the bill gave on this so far. I know there's been some questions if you've got a non-filer from multiple years before that. There has been no specific information on that. Start with filing the 18 or the 19 and let's see if you get a check. But I haven't heard anything that said if you did not file for 14, 15, 16, and 17, if that would factor one way or the other. So best thing you do is file 18 or 19, give it a shot, and move on. For the children, that's $500, and that is each child under 17. So this follows the child tax credit rules. So please be aware for those parents out there who are going to be like, hey, I didn't get my full rebate, but they may have a high school senior or a college student who's not of age. And on top of that, as it says, that high school senior or college age child is not going to get a check either if they are still your dependent on your return. So please be aware how that works going through the $500. Let's go to the income thresholds. So right now for single individual, that's 75,000 when that starts on your AGI, and you will have no rebate after you hit 99,000. So I just gave an example of how the rebate check is calculated. If you had 86, so you can run that math for any situation, whether it's single, married, filing joint, which is just double the single. And please realize head of household had its own threshold different from either of the two. Now, how does the $500 work for the child and how it affects your thresholds? So notice the top end of each individual threshold has an extension. The scenario I give in this example is for 2 children. So for every child, you're going to add $10,000 to the top end of your AGI amount. So the examples in red you're seeing is for a 2-child household, how it adds $20,000 to the top end. So on the example we looked at on the previous slide, with an $86,000 AGI, you now see an increase to that rebate check to account for those children. Example 2 I wanted to share because the AGI of $209,500 originally would have resulted in no check whatsoever for that married couple. But when you add in 2 children, they're going to get a small rebate check of $425. All right, I did some FAQs. We're going to go through these fairly quickly. Hopefully addresses a lot of the questions that are out there. Which return does the IRS look at to determine any of the information about whether you get the check? They're going to first look for your 2019 return. If that's not there, they're going to look for your 18. If you don't have either one of those filed, you're not getting a check. So you may have been great up through 2017, but that won't matter for this check. So you need to have an 18 or a 19. Also, and I think it's the next slide if you want to hit that next before I jump ahead of myself. The fastest way to get your check is direct deposit. Now, here's the challenge you may have is in 2018, let's say you owed a little bit on your return, a couple $100. There's no reason to put direct deposit information. You mailed a payment. So now you'd want to file your 19 if you wanted it direct deposited to get that information in there. Outside of that, to plan for that check to be mailed. What if I made less money in 2019 than I did in 2018? And based on my 19, I'll get more in the check, but I have not filed yet. So here's how I wanted to throw this one out there to you. If you filed your 18 return and it is less than the AGI income threshold, you will get a check even if you haven't filed 19. We've said that already. However, if you file your 19, that's going to overrule 2018's AGI, and that's going to become the threshold you're measured against. So coming back to the question, if your 18 return income is too high to get the check, and you hustle and get your 19 return in there, you're now eligible to get those funds. So get that 19 return filed immediately if that's what applies. What if I have not filed for either 18 or 19 because I had no income? Now, this kind of gets back to some of the direction that's been out there. I think that got confusing with the direction from the IRS on Social Security. Right now, you need to go file some kind of 19 return. And back to your point, Knox, about not being able to put a 0 in, you still need some return in the system to qualify for the check. So whether you're a full-time student with an income below the standard deduction, but you've got to get some 19 return in there to qualify. Knox, any other thoughts on that one?
No, I 100% agree. And you know, you can be below the filing threshold, but still have some income. And we see this frequently where, you know, a kid has $19 in withholding and it's not worth it to pay for the return, or it's not worth it for the kid to file. Well, now it is, right. Particularly if they cannot be claimed as a dependent on someone else's return, which is, you know, questionable in that particular scenario. But anyhow.
That is true. All right, here's our roller coaster of my slides. We've already covered this. So the question was, what if I do not file any return because I get Social Security? So when I wrote this originally, this was last weekend when I first started writing on this, the answer was, Knox, if you'll hit that, you just don't need to worry about it. It was in the law. You're going to get your check. They're going to base on your Social Security and move on. However, then we get the IRS IR 2020-61. That was put out Monday, March 30. And we've already seen this note before that IRS was saying Social Security recipients would need to file. And the whole world blew up about this in the tax world. So then we said, wait a minute, because Knox, I think I texted you, this was Wednesday, like Tuesday, and said, hey, I need to change my slides and account for this new law. And so I'm working on it, and I send Knox a brand new draft. And then you sent me a note, and I saw it this morning that said, wait, here we go. Now, Wednesday, April 1st, I noticed the IRS just updated IR 2020-61. They didn't put a new one out. They updated, so you'll see a new date on it. But also at the U.S. Treasury put their own statement out saying, wait a minute, our bad, we didn't, whichever was their intent before, they changed it back, and now they'll base it off the SSA 1099s, or as everything's spelled out here. I do have one thing to share on that. If you go back that one page, Knox. I did highlight in red the date of these notices. Unless this is the ultimate IRS April Fool's joke of all time, we can follow this and we're good. I'm going with that. I just wanted to share what I thought of the April 1st, 2020 part of this. I couldn't help it, Knox. I'm sorry.
That's all right.
And on that note, I'll tell you, I've been enjoying a lot of the authors on Forbes.com. A lot of you probably know Tony Nitty. He's a senior contributor, done some great work, but Kelly Phillips Erb was all over this from the beginning, writing articles, trying to drive this conversation. I know others have too. I'm not trying to just call that out, but please be aware. I mean, there's some really good stuff going on there. And I just wanted to share that as far as I saw, she was one of the first to break this and go after that. So just a shout out to them. All right. Next question. I am in trouble right now. I have been laid off in 2020 due to COVID-19, but I made good money in 18 and 19 that would have exceeded the highest limit per the stated amounts. Now, what do I do? I've got some bad news in the short term. There will not be a check coming for this person. But when you file your 2020 return, you will then get the money. And that's because technically the way the law is written, you would have started looking at the 2020 return, but since that's not been filed, we go to 19 and then to 18. So in this particular situation, they will not get a check as it stands, but next year when they file subsequent for 2020, then they'll be eligible to get the money then. So bear of bad news on that one. Is the check going to be considered taxable income to me on my 20 return? No. What if my income is higher in 2020 than my returns for 18 and 19? Do I have to give the money back? No. What if I owe the IRS on back taxes? Do they keep the check? No, the check will not be taken to repay back IRS taxes. However, there is a note in here about child support. Not on the slide, but child support can be offset with this check. Is it a one-time check or will there be more? This is a one-time check, and there will need to be new legislation to authorize any more disbursements like this. Earlier, I said about direct deposit was the fastest way to get a check, but you didn't say when we're going to start to see the money. So this is what I've written up so far as our best educated guesses right now. The initial estimate was they expected the direct deposit to go about April 6th. I think they're pushing that out now later into April. So currently, they're hoping to get direct deposits done in April at some point. Now, if you look back history-wise, last time the Treasury mailed out checks, it took 8 weeks from the first person to get their check to the end. So let's say they can get checks running by May 1, and that still may be too aggressive. You wouldn't see, there'd be still people looking for checks 8 weeks later, all the way up to the end of June 30. So you've got an 8-week window. We base it on the past that you need to depend on, and we just don't know a date yet of when those checks will begin.
So we're going to go ahead and launch our next polling question. This polling question, the Families First Coronavirus Response Act requires me to post a new poster. I can do that by, and you have a few options here, posting it in the break room, emailing it to my employees. I need to do both of the above. This is not important. Just ignore it. While you're doing that, I'll give some of my own commentary on what Vaughn was just talking about. I agree with him. That's what happened historically. However, historically, we did not have the bulk of the IRS sitting at home because of a virus. And so the last time we had these stimulus checks, the IRS was still working in terms of physically at their plants to push these checks out the door. What I am hearing, and this is scuttlebutt, this is not official. What I'm hearing is that if you are direct deposit, we should begin to see those before the end of April, but it could be 4 months before we see paper checks. And so the IRS is going to put up a website or some method for people to go and input their direct deposit information, hoping that people will do that. I will tell you that we don't have those details yet, and there are several of us that are very concerned about the security and fraud side of that. But I think that's most likely to be attached to your personal IRS account, meaning, the one that's so easy to get because it's tied to your cell phone that all of us dealt with when we were dealing with getting into TDS and all of that. What was that, 2 or 3 years ago when they changed all that? I don't even remember now. But yes, those same security guidelines to get in, the ones that we know that less than a third of our taxpayers are able to satisfy and able to get into those accounts. My best guess is that it's going to be tied to that with how they update their direct deposit information. Do I know that for sure? No, I do not. But those are my best guesses on that. So, all right, we will looks like we have about 1,120 some odd responses here. I'll give another 5 seconds. Closing in 5, 4, 3, 2, 1. And the bulk of you, 75% of you got it right. And that is that you really need to do both of the above, posting it in the break room and emailing it to your employees. If you have any employees who are not currently working in your facility, you need to email. If you have any employees who are currently working in your facility, you need to post it in the break room. And so for most of us, we need to do both of the above. There are some situations in which you may be able to get by with only posting it in the break room. If everyone is still working there, no one is already at home, you're still 100% operational, and that's going to remain true through June 30. Then you're good to go. Posting it in the break room is going to be good. I kind of doubt that's going to be the case for most of us. If everyone is already home, nobody is still in the office, including yourself, then you can email it to your employees only. You don't have to break the stay-at-home order to go and put it in on the break room. But if both of those are places that people might see it, including just yourself as an employee, then you need to do both of the above. So that's going to be the bulk of us. The 10 people that said this is not important, just ignore it. I hope that they were joking. All right.
Hey, we are open for one question.
Yep, go for it.
All right, back on collections, because I saw a lot of chat going on about, and I believe Kenneth was the gentleman who answered this, I thought quite well. Please understand, this whole thing about collections on hold does not include not having to answer revenue officers. I think, Kenneth, you said something about notice of deficiency, auditors. It is really applying to any work you may be doing with ACS, automated collections. If you're still working with a revenue officer, you have to respond to them and communicate with them. That is not the intent of that statement. Their statement was very clear that field officers can do work. I'm communicating with them daily on my cases still. So please be aware you need to reach out. The comment about the installment agreements on hold, that may be the case, but if you're working a revenue officer case or an audit, you need to confirm that with them and make sure they agree with that because they have different rules. And yes, a revenue officer can get approval for a levy even in this time. So I just wanted to hit on that. Please communicate. If you're doing a high enough case, do not just assume you do not have to communicate. Thanks, Knox. Let me slip that one in there.
Helps if I turn my mic back on. A couple of you are asking about handouts. If you did not get those handouts, then for some reason, email me and I will personally send them to you. But obviously that will be after the webinar because I'm in here at the moment. So, all right, we're going to talk briefly about unemployment. I'm not going to spend a ton of time, but I want to spend enough time because we're getting lots of questions about this. And it is one of the things that has to be factored in as we're talking about how to help our clients. And I can call this tax because it's relating to unemployment tax. So there you go. I'm calling it tax. Who is a covered individual? A covered individual is not eligible for regular compensation or extended benefits under the state or federal law or pandemic emergency unemployment compensation under Section 2107, including one who has exhausted all other rights. So the bottom line is, well, we'll get into this in just a moment. Who is it? It's someone who provides self-certification that the individual is otherwise able to work and available for work, except that they are unemployed, partially unemployed, or unable to work solely because the individual has been diagnosed or is experiencing symptoms and seeking a diagnosis related to COVID-19, or a member of the household has been diagnosed with COVID-19. Also, though, they could be providing care for a family member or a member of the individual's household who has been diagnosed, or a child or other person in the household for which the individual has primary caregiving responsibility is unable to attend school. Ding, ding, ding. This is the one that's going to catch a lot of people, right? So it's basically all of the things that we've talked about before. You're personally impacted, or someone in your household is impacted, or you've got a school situation that keeps you from being able to go to work. This is actually going to impact quite a number of people. And in these cases, then they are going to be eligible also if they are unable to go because of a quarantine. So, for example, a stay-at-home order that has been imposed as a direct result. If the individual is unable to reach that place of employment because you've been advised by a healthcare provider to self-quarantine, or if you were scheduled to commence employment and do not have a job or unable to reach the job as a result of the public health emergency. So this could even include people who anticipated going to work, but before they were able to actually go to work, weren't able to, they can get unemployment. This is not normal. Okay, but they're going to be able to qualify for unemployment as well in this particular case. Or the individual has suddenly become the breadwinner or major support for a household because the head of household has died as a result of the coronavirus. Or you've had to quit your job as a direct result of the coronavirus. Or your place of employment is closed as a direct result of the coronavirus. Or you meet any other additional criteria that the secretary may provide. Bottom line is they are making this expansive. If you are impacted by this thing in just about any way, then, and you can't go to work, you're unemployed or underemployed, you're going to be able to qualify for unemployment here. Also, persons that are self-employed or seeking part-time employment and not having sufficient work history or don't otherwise qualify are still going to qualify in this particular scenario, assuming that they do not have the ability to telework. So, for example, Vaughn's practice, my practice, we have the ability to telework, so our people aren't going to qualify. We're still working, right? Even though we're from home. So they're not going to qualify. I'm not going to qualify. Vaughn's not going to qualify. Ty's not going to qualify. Most of us in this business are not going to qualify. However, there are some who do because they aren't set up for telework. But lots of people in other industries. I mean, almost all of our retail shops, almost all of our restaurant people. The list goes on, right? Even some churches, by the way, and nonprofits are included in this. I'll talk about that in a minute. But in many cases, churches are closed and basically only the pastor is remaining on the payroll in some cases, and they're having to lay other people off for unemployment. Typically, churches or other nonprofits are exempt from paying into the state unemployment and don't pay that. And so typically they would not have unemployment benefits, but in this case, they do. What is the covered time period? It goes back to January 27th and lasts through the end of the year, although the increased pay that we'll talk about in a minute is only through July 31 currently. It cannot exceed 39 weeks for a covered individual. And I'm not going to get into the payment calculations overly because those are beyond the scope of a tax professional, but basically it's whatever the state pays plus $600. And this is on a weekly basis. So it's pretty significant. And again, it is extended to include both nonprofits and governmental entities that normally would not be eligible because they do not pay in. All right, let's talk about retirement funds because we have some special rules for the use of retirement funds. There are some tax-favored withdrawals from retirement plans that are available to us now as well. Basically, Section 72T is waived for any coronavirus-related distribution. What does that mean? It means you're not going to pay that penalty. So everybody knows what I'm talking about, right? The early withdrawal penalty, and you're always looking for those 72T exceptions. If you didn't know what 72T was, you've heard it before, I guarantee, if you're a tax professional, because you've gone and you've looked up, what are those 72T exceptions? Do I have any exceptions that I can get my taxpayer out of paying this penalty? Well, now, any coronavirus-related distribution, we'll define that in a minute, up to $100,000 in the taxable year, and you can repay it within 3 years. If you repay it within 3 years, it's going to be treated as an eligible rollover as if it were trustee to trustee within 60 days. This is pretty huge, right? Because you could have someone who pulls these things out. They're not going to pay it back within 60 days, right? We're still within this thing, but things get better a year from now, 2 years from now. They're able to put that money back in, and this is not considered a contribution, so this can be beyond the normal contribution limits. They're able to just put that back in as if it were a trustee-to-trustee rollover. Really, really significant that we're able to do that. So how do you qualify and who is eligible? Well, first of all, it has to happen in 2020, and the employee certification on their own is sufficient. So there are 3 basic ways that you qualify. First of all, you're personally diagnosed. So once again, you have a personal issue, right? Secondly, your spouse or dependent is diagnosed. Once again, someone in your household. But there's a third thing here that's a lot easier to hit, and that is that you are experiencing adverse financial consequences. You've been furloughed. You've been laid off. You've had your hours reduced. You're unable to work due to a lack of childcare. You've had a closure of your business, reduced hours of your business. Whatever kinds of things, those are specifically spelled out in the law, by the way, but there's also some leeway there to give room for, are you experiencing adverse financial consequences? And you're going to self-certify. The employee will certify, and that is sufficient for the employer or the plan administrator to take that. Now, you can also do loans up to $100,000. Now, those have to happen within 100 to 80 days of enactment. So it was enacted, by the way, on March 27th. The outstanding loans with repayment dates that are currently out there and are set to be due by December 31 are automatically extended by 1 year. And we're also waiving the RMD, or the required minimum distributions. Now, why is Congress waiving the RMDs? Well, if you're like me and you have made the mistake of looking at your retirement accounts or your stock portfolios at some point since all of this started, you have noticed that you have taken a serious hit, right? My net worth is worth far less today than it was 60 days ago. And for each of us that have retirement accounts or investments, that's going to be true. It doesn't matter whether you're in stocks, bonds, it doesn't matter. You have lost money. Bottom line, you've lost money. So to not have to take those RMDs this year is huge, because that gives us time to get beyond that, and the market will rebound. We know that historically. So that gives us the worst thing we want to do is pull out when the market is low. That's when those of us who are able want to throw money into the market, right? I want to buy when it's low. That's what I always strive to do, right? You never want to take out when it's low. That's just smart financial strategy, unless you have to. So they are giving you the ability to pull out if you have to, but they're also saying we're going to waive these required minimum distributions so that you do not have to pull money out when it's low if you don't need to do that. Pretty huge thing there. We're going to also talk about charitable contributions, but before we do that, we're going to launch our next polling question. And this polling question, unemployment is available for nonprofits, those who work for nonprofits, under the CARES Act. True or false? All right, a couple of you are trying to send me private chats. I am not the one monitoring Q&A, so just be aware of that. I mean, I'll probably see it, but Ty is actually monitoring the Q&A and answering those. So if you send it to me privately, she won't see it. Gives a much less chance of it being answered. So throw it into the Q&A tab is the best way to get those answered. So that is where we will answer things for sure.
Hey,
and go ahead.
I'll take a couple of questions on the check we talked about. I'm not exactly sure some of the answers to this, but we're seeing a lot of them. So let's try to discuss it. What is the cutoff date for filing a return to get the check? At what point will they start looking at 19 versus 18? Knox, have you heard a specific date?
Yeah, so we don't have a specific date. What we have from the IRS is just do it. So what you need to do is they're going to continue to issue these things pretty much through the end of the year, is my opinion. And so, when you can do it, get it filed, and they're going to issue these things. So that's the bottom line. So they're intentionally not putting a cutoff date because there are some who don't feel like they can get to the tax preparer's office. We have VITA sites that are closed. We have AARP tax aid sites that are closed. So some of our people that are in the low income population or the least able, senior citizens and such that may be the least able to go online and fill these out on their own. These are the very people who would be most adversely impacted by not being able to file. And so Congress and the IRS has not wanted to say, here's the cutoff date. They're waiting to say that. My opinion is they will honor these through the end of the year.
And let me clarify one thing based on a question that I said earlier. When I brought up the whole serial non-filer challenge, right now the only indication is you need to have 18 or 19 filed. So theoretically, you could file 18 or 19 and get the check, even though you haven't filed before that. I haven't seen any clarification from anyone one way or the other about serial non-filers. I was just pointing out, at least file 18 and 19 and give yourself a chance to get the check versus assuming someone hadn't filed in 7 years won't get it if you don't file 18 or 19. Knox, thoughts on that?
Yeah, I agree. And somebody is asking too, what about married filing separate? What's going to happen there? And what's going to happen there is you're going to get two $1,200 checks.
Yeah, that makes
married
sense.
filing joint is going to be one $2,400. Now, I'm oversimplifying that. I'm not assuming any dependents, and I'm not assuming any AGI issues, right? But you get the point. All right, well, let's look at how the poll is happening here. And, we have over 1,100 responses. We're going to close it in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. The correct answer is true. Unemployment is available even for nonprofits under the CARES Act. So that is a true statement. It is not normally true, but it is true under the CARES Act. All right. Let's talk a little bit more about charitable contributions. Some of you know that I happen to also pastor a church, so this is near and dear to my heart. And some of you have been in the business long enough to remember that there was a few-year period, 3 years maybe, in which we could do an above-the-line deduction for charitable contributions. I don't even remember what years those were. It's been a while now. But if anybody remembers, throw it in the chat or something, let me know. But there were a few years you could do this. And what we're saying is that we can now do up to $300 above the line for tax years beginning in 2020. So this is pretty big news. Also, we have a 60% limitation. Now, remember, it was 50% limitation prior to TCJA. It moved to 60% under the Tax Cuts and Jobs Act. And now for 2020 only, it is increased to 100%, which means that you can have a charitable contribution of up to 100% without having to carry that forward. Corporations have been limited to 10%. That is increased to 25% for 2020. And food inventory is also a big deal, particularly for corporations. But for contributions of food inventory in 2020, this is increased from 15 to 25% as well. So pretty big news there. And with that, I'll turn it back over to you, Vaughn, to go through what everybody wants to hear about.
Yeah, and I tell you, there's tons and tons of questions coming in about the payroll protection loan, often called the Payroll Protection Program. So you'll see PPP or PPL. Questions on the $10,000 grant, also the emergency disaster loan, which is called the EIDL. So we're going to do our best to compare all of these, explain the details, hopefully answer a lot of your questions. There are still a lot of open questions to this, even for us, because the direction has not come out yet. And I know one of everybody's favorite questions to ask is about the whole, hey, I can pay subcontractors as part of the PPP loan. We'll do our best to kind of point you in the right direction on that, but we're all waiting for extra information from the SBA on that as well. So let's go ahead and dig in. We've covered this next slide after this one. So we'll jump ahead. Thank you, sir.
Sorry, totally forgot I was doing your slides.
Yeah, you got that's right. So look, everybody, Knox is super sharp with his slides. You'll find I'm far more casual. Is that the right way to say it, Knox? I wrote this whole next section really aimed more at answering questions from your clients. The information's there. You've got the backup. But as we go through it, if you knock me out to the next slide there, Knox, you will see this is the question everybody, you all and your clients are asking. How do I get cash as fast as possible? And which one of these things are going on? I had someone say what you're about to see right now. Is it the PPP loan? Is it some SBA loan? Is there some secret way I've heard about on the internet to get 10 grand cash and quick? Then I added, but I really don't want to meet some dude in the back alley to get the cash. So we're going to talk about all these things. Let's talk about them at a high level first as what I consider the three main options. Option one, if you need quick money, you need to do the immediate $10,000 emergency grant. That is done at SBA.gov as part of option two, which is the SBA EIDL, the Economic Injury Disaster Loan, which is a continuation of the application you'll start for the emergency grant, also done at SBA.gov. And then we're going to talk about how all of those relate to the PPP, the Payroll Protection Program loan. All right, short descriptions. Let's start with option one. So the immediate $10,000 emergency grant. This is the fastest way you're going to get financial assistance. And in a silo, it does not have to be repaid if you use it correctly. That being said, once we start talking how it relates to the PPP, the Payroll Protection Program, you will see there are different rules about repayment between the two of them. You need to use the $10,000 for specific broad purposes, payroll, mortgage and lease payments, other obligations. If you decide to do a PPP loan and have taken this grant, your forgiveness of the PPP loan will be reduced by this $10,000 grant. So let me translate that. And you'll see an example later. Let's say your PPP loan's 50 grand and you get 10,000 as well for this grant. Essentially, you'll need to pay back the $10,000 grant. So just keep that in mind through the terms of the PPP loan. You get this funds directly deposited in your business account. They are saying right now that's within 3 days of your application. So, I've got some clients who've applied for it first thing Monday morning. They haven't gotten the funds yet. So is that 3 business days following the business day of your application? If so, that would be tomorrow, or they're coming in at some point today. And you can do this right now at SBA.gov. When you look at that website on SBA.gov, right at the top, there's a yellow bar and it talks, there's a link right there for the EIDL. If you click on that and go through that application, a few pages in, you'll find the question asking about the $10,000 and a spot to put in your account and routing number for that money. All right, let's talk about the SBA EIDL program. This is more money than the $10,000 grant, for I would assume for just about anybody, or the PPP loan. It will take longer to get these funds, and there is no guarantee you're getting this loan. This is different. It's far easier to get the grant and the PPP loan than it is to get the EIDL. There is no guarantee you're getting this one. I borrowed this next part from a friend of mine who taught with us yesterday. Think of it as longer-term support for operating expenses and debt payments for businesses experiencing disasters. You'll begin this loan application at SBA.gov, and as of Monday, as I mentioned already, it's the same application that starts for the $10,000. Now, as part of the CARES Act, Congress relaxed the documentation requirements for EIDL loans of $500,000 or less. Best guess, you need to look at 45 to 60 days after you have finished your submission. And that's not necessarily easy for the full EIDL. It's much quicker to get through the $10,000 grant section than it is this. There's plenty of documentation they want for that. Then plan for 45 to 60 days. And that generally was the window before all the SBA was about to, on their normal processing speed. Now they're going to be overwhelmed in this, so don't be shocked if it takes longer. And you can make this application right now as well.
Yeah, and let me just comment briefly there, Vaughn. There are about 2,500 underwriters, is what I'm hearing, who the SBA has to be able to address all of these, including the grants. How many of these do you think have come in just in the last week since they opened up this grant? And I guarantee you it's a ton. I don't have the number, but I guarantee you it's a ton. And every one of them has to be looked at by one of these loan officers, and they have to press the go before those funds are going to be released into the account. And we're not even talking about looking at this option 2. We're just talking about the grant. So I'm not shocked that I haven't seen that money hit my account. I'm not too proud to say, by the way, that I applied for it on Monday. I'm not too shocked that I haven't seen that money hit my account. I think their goal was 72 hours, but they are flat out understaffed. So just be aware of that.
No, very fair. Thanks, Knox. All right, let's talk about option 3. This is the Payroll Protection Program. And just as a note, we're just going through these short descriptions. We're going to go a little deeper into some of this as we go. All right, this is a short-term loan to help you pay for 8 weeks of payroll, rent or mortgage, and utilities. Ideally in their plan, it was going to be get these funds faster than the EIDL program, but slower than the immediate $10,000. Yes, there is a capability with the PPP to get the principal forgiven. And we're going to talk about the difference between the principal and the interest here in more detail. If you take the immediate, I've mentioned this before, but I'm going to oversay this. If you take the $10,000 immediate cash advance in option 1, and then receive this PPP loan, your amount of forgiven funds will be reduced by that $10,000 grant. So please plan for that in your math. Now, you do not apply for the PPP at SBA.gov. You will go to an existing SBA lender. They have, what was originally committed was existing SBA lenders would start taking applications tomorrow. I was emailing with one just 30 minutes before we started. They're still expecting that to happen, but they do not have the guidance they need to fully understand this from SBA, and they're all still waiting for this. So again, you're going to submit it, and it's probably going to sit there for a while, and we don't, although I'm expecting, I said here, 30 to 45 days from today as far as when you submit it. I'm not sure that's right or not. That's just an initial estimate to think about. Another distinction is the application for independent contractors has been stated as next Friday, not tomorrow, but next Friday, April the 10th. Okay, we're going to go back in a little more depth into each of the 3. This is just a repeat of what we've already said before on option 1. So we'll go to the next slide. All right, Congress expanded the EIDL program to create this grant. And that's, again, this immediate $10,000. You can use it for any and all operating expenses, including your payroll. And yes, if all you get is the $10,000, you do not have to repay it, even if your EIDL loan, the full loan, is denied. So you still get the 10 and you don't have to repay. What starts to get challenging is if you do the 10 and the PPP. We talked about the arrival of the funds. We'll see if Knox gets his money tomorrow or not, or anybody else who applies on Monday. Odds are they will not. How long did it take? I did it, took about 10 minutes, not even that much. Things that you're going to want to have with you. I would have your most recent business return. So you have your EIN number, full name, all those things. It asks for your gross revenue for the last 12 months prior to the disaster and your cost of goods sold for the 12 months prior to the disaster. And again, you don't have to submit any documentation when you do this grant, but you do have to attest under penalty of perjury that the information you're sharing is true and correct. And then you need to have your direct deposit information for the grant, your name, account, and routing number. Question, what if I've already begun an application on SBA.gov for an EIDL loan prior to Monday? Will that previous application default me into the $10,000 grant request, or do I need to go back to SBA and submit a new application? You need to go back. It will not carry through. They're asking you to go back and submit a new application, and that was as of Monday. So make sure you go back and do that. Now, we've already talked about who's getting the money when. We'll just skip this slide. Knox, you nailed that for me. Appreciate it, sir. All right. Now let's talk about the EIDL loan before we get to PPP. And this just repeats what I mentioned earlier about it's more money than the PPP or the grant, but will take longer. We can go ahead. That's just a repeat from earlier. Thank you, sir. And I brought in some slides from someone I taught with yesterday, Eric Glimp. So Eric, if you're out there, I appreciate you letting me share some of this. All right, SBA loans on the EIDL are up to $2 million used to pay fixed debts, payroll, accounts payable, and other bills. It's a 30-year fixed rate, 3.75% for profit and 2.75% for nonprofit. You can defer your payments for 1 year, but interest will still accrue. Loans are issued directly from the SBA, not the banks. Small businesses, nonprofits, sole proprietors, and independent contractors can all apply. If it's less than $200,000 on your loan, you do not need a personal guarantee. And the streamlined application process is what we mentioned before. That has already begun. So again, we're not going to go too deep in the EIDL. That wasn't what today was about. This is what we want to talk about, is the Payroll Protection Program. So again, we've covered the short description, but let's go in deeper into this. We need to start with intent. It is to keep your employees on payroll, rehire the employees you laid off because of COVID-19, and then pay for specific expenses that keep the business doors open: rent, utilities, and mortgage interest. And we mentioned payroll up top. So this is going to matter later when you go after forgiveness, and we'll do a deep dive on forgiveness. But keep this in mind as we go. All right, what lending institutions can I apply to? Any SBA lenders who've already been approved. They are trying to add more lenders because they know they're going to get so much volume. But right now, you need to start with someone who's already SBA approved. Application period. Well, it started in the past to all the way to June 30, 2020. Now, here's a note. This period has nothing to do with how you spend the money. When we talk about the 8 weeks, the 8-week period begins with a loan origination date once that's final. It has nothing to do with this window of application. Just want to make sure that everybody understands that today. Now, talk about things that change. So the original bill, we saw lots of write-ups of this, that there was going to be a 10-year max maturity on the PPP loan and a max 4% rate. But as of Tuesday evening, early this week, they changed this to 2-year max maturity and a 0.5% rate. I will tell you, the math I have been running for clients and even myself considerably changed, because if you start to look at the $10,000 as well as the Payroll Protection Program and how fast you have to pay that money back, a 2-year window versus 10 is a substantial payment. You're looking at about $500 a month if you have to pay back the $10,000 emergency grant amount, even at the 0.5%. And that's just a ballpark. So I ran some of the numbers, want to point that out, because at 10 years and 4%, it was about $120 a month. So if you've been running math this week and didn't realize these factors had changed, please be aware. Also, fees are waived. There is no collateral, no personal guarantee, no prepayment penalties. And they had said payments could be deferred 6 to 12 months. They've come back and said it's just 6. Who qualifies? Small businesses with fewer than 500 employees, sole proprietors and independent contractors, and nonprofits. But that's 501c3 only from what I've seen. Knox, have you seen anything different recently on that?
Yeah, some of the other provisions are definitely any of the 501cs. On this one, it does appear to be attached to 501c3. So that's not true for the entire CARES Act, but does appear to be true for the Payroll Protection Program. It'll be interesting to see as we get some more guidance out of SBA whether that is loosened administratively.
Got it. All right. Who or what compensation is the small business can be paid with these funds? All right. Well, employers is the easy one. It's the independent contractor, sole proprietor, and self-employed 1099s, gig workers, whatever you want to call it. It's just not clear how this is going to work. We've seen some behind the scenes guidance that, yes, the law said that independent contractors could be included in your application if you pay them. So we first started talking, well, does that mean if I send a 1099 and it's someone's social, I can include them? But if it's a 1099 that has an EIN, they need to do their own? And see, there's no guidance on this yet. We are starting to hear behind the scenes from some of the banks that they believe SBA is going to clarify that if you get a 1099, you need to do your own application, because they're worried about double dipping. So I would make an application, I would include somebody who's an independent contractor, and then that same independent contractor makes their own application. And this won't be reconciled at some point for who knows how long. And then they'll realize that the parties all got the same money and it was a double dip situation. So Just please be aware, it is probably going to be safer for each business to apply for only their employees and have the independent contractor make their own application. In the end, it's we're waiting for guidance for all that, but that's just one opinion. Amount you can apply for. If you are that business that's less than 500 employees, you will get the lesser of your average monthly payroll costs for the 1 year period prior to the loan. And then you multiply that average by 2.5. So in this example, I gave a $10,000 per month average times 2.5 is your loan amount is $25,000. So it's the lesser of that calculation or 10 million. So I already saw one of the questions is what is the period of this 1 year prior to the loan? The draft application says it's 2019. There is more detail if you're a new business in 2020 of how to do that, but their initial information is 2019. But on that note, I think you're going to take a little more time than just take your forms from last year and plug and go, because you may not have some employees that were with you in 2020 that were here in 2019. So you'll need to take them off of your calculation. In the end, you're going to need to be able to substantiate to the lender how you calculated this figure and that they're ongoing. These are ongoing employees, let's say, assuming there's no independent contractors in this. All right. Oh, I went ahead of myself and answered that question already. So right here, we'll jump to the next one. No, we're good. Thanks, Knox. How do you define payroll compensation? That's wages, commissions, salary, or something similar. And that's a max to $100,000 annual salary. So if somebody earns more than that, you got to stop at 100. Cash tips or equivalent. Vacation, parental, family, medical, or sick leave. Group healthcare benefits, including premiums. Retirement benefits. And state or local tax assessed on that compensation is included.
I think our biggest question mark here, and we need some guidance, in my opinion, to answer this, is what about housing allowances? So we do have some persons who are compensated or a portion of their compensation is with a housing allowance. It was not specifically mentioned within the text of the act or in the bill. My feeling, my gut is that it was intended to be included, but it's going to be interesting to see what the guidance comes down on that.
Thanks, Knox. Now, what else can be paid, but check my note out, but not necessarily forgiven? And we'll come back around to what that difference is. So payroll, a mortgage payment. But when we get to the forgiveness section, they make a distinction between a mortgage payment, but you'll only be forgiven if you pay on what you pay on your mortgage interest. They're not going to increase your principal for you. Rent, utilities, and other debt service requirements. Again, this is not forgiven yet. We're giving that in a second, but what you can use to pay with that.
Vaughn, we're going to go ahead and launch another polling question here. I know we're still talking about this topic, but this is a big topic, and we need to go ahead and get another poll out there. So this poll, my college student who marks the box that someone else could claim them as a dependent will still get the $1,200 stimulus rebate. True or false?
Knox, is this a test of my teaching ability from earlier?
I don't know. The questions that I wrote for your sections, people are getting all the right answers. Some of the questions I wrote for my sections, they're not. So, you can extrapolate from that what you will. But
I'll take anything I can get right now.
All right, let's go ahead and look and see, Ty, if there are some questions that I need to take real quick. Upvote those for me. And I could take one or two. So this one is for you, Vaughn, if you know the answer. If not, I'll chime in. This is from Kathy. She says, what about low income or non-taxable income people who, think like VA disability or below the minimum filing requirement who are not getting Social Security benefits? Do they need to file?
I think we're coming back to the definition of this, that they were allowing for, I think it was railroad retirement and Social Security. Outside of that, there needs to be an 18 or 19 return filed in order to qualify for the check. Knox, thoughts?
Yeah, I agree. I wish that VA disability had been included in that, but at least at this point it has not been, and so they do need to file. Certainly those that are below the filing requirement and are not receiving government benefits will certainly have to file in order to. VA disability, I think, should have been included, but was not. What was specifically mentioned was SSA and RRB. So, Kathy, my advice on that would be they do need to file.
Hey, Knox, can you go one slide back for me, please, while we're waiting on the questions?
Absolutely.
I'm going to answer a question, I think, with this slide, and we'll have a conversation. How do you define payroll and compensation? Does anybody see here owner's draw for S-Corps? No. So now you've got a challenge here. This is based on payroll and W-2s. So there is no owner draw compensation coming into this calculation that I have seen. Knox, thoughts?
Yeah, I agree.
Now, as an S-Corp person, you can claim your paycheck, your reasonable salary, correct?
Yeah, absolutely, because that you're an employee and you're receiving a salary. And if you don't have a reasonable salary, then you have other issues.
So if you've been minimizing your reasonable salary to maximize your owner's draw, it is not helping you when it comes to the PPP. So just wanted, I saw there was a bunch of questions out there about that already, and wanted to chime in on that one.
Yeah, so I agree. So when we're talking about corporations, we're talking about the W-2 wages here. That's what we're talking about. We're not talking about dividends.
And how about our partnerships?
Yeah, that's a better question, actually, right? What about guaranteed payments?
I haven't seen it.
Yeah, me neither.
Now, is something similar in this line, the wage commission or something similar? We would need some guidance on that.
However, I think that with some guidance, we have a better chance of seeing guaranteed payments in there because we see self-employed in there, right? So the question would be, how is that going to be reconciled? And might they, anyway, we're going to need some guidance on that. I think ultimately guaranteed payments are going to be there, but we don't have that answer that at the moment. And to answer Todd's question, yes, absolutely. Handouts are located in the handouts area. And we are going, I like Roxana's statement. Another reason I demanded you to be on payroll, dummy. All right, we're going to close this poll. I haven't even looked at how many, but it's been plenty of time. Yep. We're going to close in 5, 4, 3, 2, 1. And see, Vaughn, on yours, they like 94% of them get it right. So
I'll take it.
Yep.
Hey, Roxanne, on that note, based on your comment, can we just get a recording of you saying that over and over? And I can put on one of those little pins. So I'm talking to clients on the S-Corp and they're arguing on reasonable salary. I can just let you say that because that's a brilliant line and better than anything I could come up with. But I digress. So nice job, Roxanne. All right. Now, forgiveness requirements. Wow, this is where everybody's going to want to live, right? Because the whole point of taking the PPP in their mind is to get it forgiven. So let's start with it. Payroll costs can be forgiven, but only over an 8-week window of time from the loan origination date. So you just got to be really careful of the window when you start to use these funds. You get the interest on mortgages, not the whole payment. So the principal does not apply for forgiveness. Yes, you get your rent, and you can have all your rent apply against forgiveness, but only deduct mortgage interest if you have a mortgage, and utilities as well. Those are the areas you need to start with.
And let me just comment. And it looks like you're basically got that here, but I just want to highlight it again. And that is that your non-payroll cannot exceed 25% to be forgiven. So yes. Everyone needs to be aware of that. At least 75% of your expenses must be on the payroll side.
Absolutely right. So there are some limitations we're going to cover now. So first of all, you'll be applying for this forgiveness as it stands today, not to the SBA, but with your lender. And they're going to want supporting documentation. So we put some examples here. They're going to want to see canceled checks for the mortgage, rent, or utilities. And if you've got a mortgage payment, you need to have a detail of interest versus principal. The payroll report that you need to include, and this is where the information stands, is that you need to be able to show you kept your specific employees and subs. If you had them on the list when you got the loan, they need to be on your payroll now and continue to be paid. And again, just like Knox said, you've got to pay them at least 75% of their pre-COVID-19 levels, or you will not get that forgiven. Comparison for forgiveness, I think it's going to go back to your most recent filed 941. They talked about the most recently filed return. At this point in April 2nd, that should be first quarter 2020. Could you make a case for it being fourth quarter 19? Possibly. We'd have to see what the guidance comes in on that. But I'd be expecting at least first quarter 2020, and that was pre-COVID-19. And then one other note on that, Knox, is if you go back one slide for me for 1 second, is using first quarter 2020. This is different from the recommendation to use your 2019 payroll figures to calculate your average monthly payroll. So just be aware, they are using different periods for some of the information. You use your 2019 numbers for PPP application, but comparison for forgiveness is likely first quarter 2020. All right, if you qualify for 100% of the loan forgiveness on the principal, you still have to pay the interest based on the terms before of 2 years, 0.5% with a 6-month deferral. There's a lot of clients out there running around going, PPP is free money and I don't have to pay anything for it. And they just haven't sat down and run the interest numbers and really thought this through. So you will have to pay the interest on the loan. All right, question.
But that is only 0.5%, so it looks a lot better from that perspective than it did when we thought it was 4.
Yes. So you're going to love that interest amount, even though you've got less time. All right. Earlier, I know this question, I saw this question earlier, so here's the slide to answer it. We talked about the factor you use to calculate of your average monthly payroll was 2.5. That comes into an equivalent of 10 weeks. But now in the forgiveness section, you only say to count payments to employees and independent contractors over 8 weeks. What's the difference? Well, I haven't seen this written anywhere, but this is what I backed into, is that the 10-week number, the 2.5 factor, that 0.5 factor is their way to give you money for rent, utilities, and your mortgage interest. So they're approximating the 8 weeks at a 2.0 and then giving you another half factor on top of that number so you have some extra funding. It may not be what you need, but you have some extra funding to pay rent, utilities, and the mortgage interest for forgiveness. Knox?
And just as an aside, another option, of course, is you could bring on additional staff. And so, for example, for me in my tax practice, that I'm in a place where that makes sense right now. And so if I do the PPP, then I will my expense last year will be less than my expense this year, no issue. I am increasing my outflow of payroll. Now that's going to be different than for most people, but if you are in that scenario, then you could even be in a scenario where you don't get enough payroll money to pay everything. So you have to factor some of the other options too.
All right, Knox, I'm gonna throw you a question and we can debate this. This is for our tax professionals out there. Let's say you were proactive and you hired a brand new associate in November. Now they're not salaried, they're hourly. So you brought them in and they worked essentially part-time before tax season, learn your systems. But January and February, they have been they're 40 hours, all full. How are you calculating your average? Because if you take in November, December at their minimum time, you're not going to have the funds that you were typically paying them in January and February, or are you running your average on just January and February, which is pre-COVID-19 levels?
Yeah, so the answer to that is in whether or not you are checking the box that you are a seasonal employer. So for tax professionals specifically, if you typically ramp up during the season, you can claim to be a seasonal professional, and there's actually a different calculation. So you're not going to look at all of 2019 in that scenario. You are going to look at a period of time that does include first quarter. So you are going to look at a period of time that would include that. It's a different calculation, essentially. So there is a seasonal employer calculation. I don't think that most of our employers out there are going to need it, but the tax business is actually a good example of a situation where an employer may want to do that. And in the case you just described, Vaughn, that would make a lot of sense.
What if you had to mix it? Because last year you have full year-round employees and you just brought on somebody new, because their average is going to be brought down by November, December.
Yeah, so I think you have to pick one or the other. I do not see anything.
Yeah, okay.
Yeah, I haven't seen anything that we've seen yet. Now, I do think you get to pick, am I seasonal or am I not?
Right.
But you're going to have to pick one or the other. I don't think you can mix and match the calculation.
That wasn't a question that, you and I had chatted before, but I thought it was potentially helpful for everybody listening today who might have something similar. So, all right, we're going to keep on rolling. Some other nuances of the PPP loan program. If you get a PPP loan, you are not eligible for the employee retention tax credit. The loan forgiveness reduction of 25% salary rule does have an exception, and that applies for someone who earns more than $100,000. So if it's $175,000, let's say, you need to get them down to 100, the 25% rule doesn't apply. Greater than 20% owners have to be U.S. citizens, and each owner has to sign the certification that they want this loan. And you can roll the $10,000 grant and the PPP loan into your EIDL program to extend the payment terms, and we'll talk more about that here in a bit. This is a great, I thought, visual representation that Eric, my friend, did. We worked on this together and we're playing with it so you could visually see how the money all may come together. So here's an example in the gray for EIDL grant. That's the $10,000 grant. You would potentially get that now and get that $10,000 in April to help you with expenses. Then you're applying for the PPP, let's say starting tomorrow, hoping to see that money within the next 30 to 45 days. We haven't given an exact amount. But then once you start spending out of the $10,000, you go into your PPP funds. While you have an EIDL loan application, the full loan going on, now those funds come in later and carry you through the rest of the year. So I just thought it was a good visual representation of how someone could use the funds all together to operate their business. What happens if you combine the $10,000 grant with the PPP loan? I put some time into trying to make this as clear as I could. I hope it comes across that way. So I'm going to come up with an amount of $50,000 as your PPP loan based on your average monthly payroll. So option one, with a $10,000 grant or a PPP of $50,000. Option one is I only take the $10,000 emergency grant and I pass on the PPP loan. I'm not taking it. If you just take the grant, you do not need to pay back the $10,000. You're done, move on, we're done. Option two, though, I'm not going to take the $10,000 emergency grant, but I will take the PPP loan of $50,000. Now you can plan on the forgiveness of the principal of the PPP loan as long as you spend it based on the rules that we've discussed on forgiveness. And all you'd be left with the interest on that loan to pay in the remaining time at 0.5% and likely 18 months. Option three, now I'm going to take both. I'm going to get $10,000 in the emergency grant, and I'm going to take $50,000 in the PPP loan. So total cash flow is $60,000. Straight up from the beginning, you will have to pay something back more than the interest. And I think the easy way to look at it is it's the $10,000 grant. It's not written that way, but assume you're going to get the $50,000 of PPP principal forgiven. The way it reads is the $10,000 offsets part of your forgiveness. So question, why do I have to pay back the $10,000 plus the interest? And it's already in the law. If a business receives a $10,000 emergency grant from the SBA EIDL program, the PPP loan forgiveness amount is reduced by this grant. All right, so we're going to assume that all $50,000 was forgiven, and you took the $10,000 grant. I think we've already covered that. Sorry, guys. We threw this together so fast. Sometimes I wish I'd cut some slides. But we do have a fourth option I wanted to cover. I'm taking the $10,000 grant and the PPP loan, and then I get approved for the SBA EIDL loan, the big loan. Now you can wrap the repayment of whatever funds were left over from your PPP loan / $10,000 grant into your EIDL package. And now whatever funds that is, let's say it's the $10,000 plus the interest, doesn't have to be paid within that 2-year window. You're now paying it back under the terms of 30-year window of the SBA EIDL. So if you get all of them, you have another option.
All right, we're going to go ahead and launch another polling question here. And this polling question, notice 2020-20. We talked about this almost back at the beginning, so we're testing your retention here. What form does it add to the July 15th deadline? Form 1040, Form 1065, Form 1120S, or Form 709? Which form does Notice 2020-20 add to the July 15th deadline? And with that, I want to go back and talk a little bit more about your scenario here, Vaughn. So a couple of things I wanted to say. One is we should not always assume that the $10,000 grant is going to have to be repaid, because it depends on how much you are able to actually put towards eligible expenses, right? So we'll go back to my scenario earlier where I hired additional people. I've got additional payroll that goes beyond. I'm good to go, right? But there is another scenario, possibly, and again, depends on how the math works out, obviously, but there is another scenario possibly, and that is where the $10,000 grant is actually rolled into the PPP loan, not as additional money, but as part of my PPP max. And there is no guidance that tells us which way that's going to be handled. And so I think that that's going to be some lender discretion right now. But I think that many of the lenders are actually going to roll that in to the PPP max. So going back to this example, we have a $50,000 PPP max. They're going to say, you already got 10. We're going to fund you the additional 40 and consider it all 50 into the PPP. Again, we don't have guidance, so we're dealing a little bit with Knox speculation here.
In your scenario, are you spending the $10,000 grant in the allowable 8-week window of the PPP?
Yes, and that is a key, right?
Then I follow your logic. You got it. I like it. There is an opportunity there based on guidance that you could spend all 50, excuse me. In your scenario, it's still 50, right? You get a $10,000 grant. I'm not getting a $50,000 loan. They're deducting 10 from the 50, and I'm only getting 40.
Yep. Or to do it the other way, you could also do the 50 plus 10 and make the same math work.
I'm thinking, let's say you get 60 and still spend in the 8 weeks. Is there a case to be made that it was all spent on the same things?
Yes, I would absolutely agree. And so there's some planning here that we can help with our clients is where I'm getting at. And this is where we add value in our planning as we help clients, because what are the odds that our clients are going to figure out on their own they've got to be within that 8-week window, right? What are the odds they're not going to get the 10 grand and start spending? What are the odds that our clients are going to know they need to open a separate bank account to track this, or have really, really good books so that they're tracking what these expenses are spent on? All of these things are places we can add value.
On that note, my recommendation so far, Knox, you can disagree if you like. That's okay. It's just because we're teaching together.
Sure.
I'm telling my clients I would like to see whatever funds come for the $10,000 grant or the PPP go into a separate account that would transfer into their operating. Because I think trying to come back and reconcile this forgiveness when all the funds are in the operating account to show a lender is going to be more difficult if you keep all the funds in the operating account versus putting the loan and the forgiveness and the grant, all that into a separate account. And then as I spend money and I have the reconciliation, the exact amount, let's say my rent is $975, I'm transferring from my extra account where the funds are $975 to my operating. I am paying it from my operating, so I can tie every amount coming through. Thoughts on that? Shoot me down. That's okay.
Yeah, I 100% agree. Assuming that, I'm going to say I 100% agree. There are some clients that I have where I trust the accounting enough to know that they can handle it. But I have more clients that I don't. So in general, I agree.
I'm actually less worried about the clients, and I agree that I have some clients whose accounting will be fine. I am more worried about the lenders who will be looking over all this backup. And the easier, this is like working collections with the IRS, the easier you can make that package to follow, the better. And that's where I was coming from. It would just, I think, be cleaner for the lender to review it later. And to your point, whether they can get the accounting reconciliation right.
Yep. We're going to close this poll in 5, 4, 3, 2, 1. The correct answer was Form 709. Form 1040 has also been extended, but that actually happened in Notice 2020-18 and to some extent in 20-17. So it's a little bit of a trick question, but Notice 2020-20 extended Form 709. That was the correct answer. We are actually going to do a poll back to back, which I almost never do, but we're going to do it in this case.
Calm down. Don't go crazy on us here.
Yep, I'm going to do it because we're still talking, and I didn't want to cut our ability to do that, but we got to continue. So what is your preferred method of receiving your continuing education? You can select as many as apply: in-person, self-study from a text, webinar, or recordings. And with that, Vaughn, I'm going to get you to go ahead and talk about payroll tax deferral while this one's up.
Make this super fast. So payroll tax deferral. So you have an option with employers and self-employed can defer their payment of the 6.2% employer share of Social Security on the 2020 employee wages. Self-employed can defer 50% of their self-employment taxes. Payroll tax deferral period is March 27, 2020 through December 31, 2020. 50% of those deferred taxes are due December 31, 2021, and the remaining is due December 31, 2022. And again, if based on some of the programs we just talked about, you cannot do this as well. Knox, I couldn't come up with a whole lot of scenarios where it made sense for clients to do this versus PPP or the grants or anything. Thoughts?
Yeah, I agree. Let me talk about the next one, and then we'll talk more about all of the options.
Okay.
So the employee retention credit, and Vaughn, go ahead and close that poll in like 10 seconds. Just do it automatically. So the employee retention credit, there's a refundable credit that we need to be aware of here. So it is refundable. It is for 50% of the qualified wages in each qualified quarter. So we're going to talk a little bit more about that. But the employee wages are up to $10,000 in aggregate for that employee. So even if I'm going over multiple quarters, it's $10,000 in wages in aggregate for that employee, which means that my maximum credit is $5,000. Some of our other fellow CE and CPE providers have not gotten this correct, but that is the way that the law reads. So it's important to understand that the max credit is actually only $5,000 per employee, because we're looking at employee wages of $10,000 in aggregate per employee, and then we have to take 50% of those qualified wages. So that's important to get, or the whole math will be off. The second thing to remember here is who the eligible employers are. So it's, first of all, obviously they have to be carrying on trade or business during 2020, duh. But with respect to any calendar quarter in which the operation of the trade or the business is fully or partially suspended because of a governmental authority. So these are the stay-at-home orders, only the essential businesses, this sort of thing. If the business is impacted by this, and they are unable to fully operate, fully or partially suspended, then they're going to qualify for that particular quarter. Or, this is the or part, they can also have a significant decline in gross receipts. How do we define a significant decline in gross receipts? It's 50%. So if I have had a decline of more than 50%, in other words, my receipts are less than 50% of the same calendar quarter in the prior year, then I have significant decline. And we're going to continue to count each of the quarters that are that way until we get our gross receipts back to or greater than actually the 80% that we had from the calendar quarter in the previous year. So we could have multiple quarters impacted. So for example, we could potentially have quarter 2 impacted. For some of our taxpayers, they could even have quarter 1 impacted here, right? We could have quarter 3 impacted, and God forbid, we could have quarter 4 impacted, depending on how this thing goes. So it's not impossible to see a situation in which we have multiple quarters impacted, but we'll talk more about that in a minute. So when does this begin? Well, it's basically for the whole year of 2020. So it begins with the first calendar quarter after December 31. So that's quarter 1, right? And it goes all the way through the end of the year. Now, 501Cs are eligible. Notice I didn't say 501C3s here. I said 501Cs, right? So where we pointed out earlier that it may be only 501c3s that are eligible for the PPP, this credit is open to all 501Cs. So this is going to be open to our associations, et cetera, would be able to claim an employee retention credit. This is helpful for those organizations that have employees. So wage calculations, however, are going to vary. It's going to depend on whether they have more than 100 employees or if they have equal to or less than 100 employees. So if it's greater than 100, then only the employees that are not providing services, so they're at home and they're not working, those are the ones that count, and only those. But if we're talking about a business that is 100 or less, then all of the employees count, even the ones that are still working and providing services, even if from home. So that is something to be aware of. And obviously we can't double dip here. So we're not going to be able to double dip with our sick leave or family leave. Those benefits are going to be excluded from this. The other thing we have to pay attention to is the aggregation rules, which is too complex for me to get into in the couple of minutes I have, but I've given you the section numbers to look at. And the other thing is that PEOs and other third-party payers are specifically allowed. So let's look quickly at an example. Company A has 2 full-time employees, each at $4,000 a month, 3 part-time employees. The average monthly payroll is $10,000 a month. We're going to assume that they're impacted, and we're going to assume that their revenue is down by at least 50% in both quarters 2 and 3, and that they're back to greater than 80% in quarter 4. So what are the options that could help with this payroll cost? Go ahead and put into the chat for me, if you will. What are some of the options that this particular company could choose to help with their payroll costs? So throw that into the chat for me, and we will see how you all are doing on that. And it looks like, yeah. So what are the options?
Hey, Knox, real quick, I can't close that question out for you, by the way. I'm locked out of that.
Okay, I did it.
Thank you.
Not a problem. All right. So what are our options that we can choose here? Well, our first option, obviously, the quickest option is they can go and apply for that disaster grant, right? That $10,000. So they can go and do that. Absolutely. And that can help them with their payroll cost. We know that. What's another option that they could do? Well, they could go take the loan, right? The fully underwritten loan could be up to $2 million. That we can see on that. And they could take the PPP. So in this case, we know their average monthly payroll is $10,000. We're going to take 2 times the monthly payroll, and then we're going to add another 25. Well, anyway, bottom line is it's 25,000. It's basically 2.5 times is the monthly payroll calculation that we take there. Or we could do the employee retention credit. So here's the math on the employee retention credit. We know that the average monthly payroll is $10,000, but we know that there are 2 full-time employees in there that are each making $4,000. We've got 2 quarters involved, so they're going to each max out at more than the $10,000, correct? So we're going to go ahead and take those, and we're going to take 5,000, which is 50% of the $10,000. So that's 5,000 times our 2 full-time employees that are maxed out. So we've taken 8,000 out of the monthly payroll and only left 2,000 for the remaining 3 part-time employees. So we're going to take that 2,000, we're going to multiply it by the 6 months that are involved in quarter 2 and quarter 3, and then we're going to divide that by 2 or multiply by 50%, depending on what your preference is. And so if I've done my math correctly, we've got about 16,000 here. Now, we cannot take the employee retention credit and the PPP. We cannot do both, right? It is a either or scenario. So in this scenario, and in almost every scenario where I have run the numbers, the PPP is going to make more sense. But there are some organizations that won't be able to do the PPP. And we just named a good example, right? If only the 501c3s can, there may be some other 501cs that want to take advantage of this employee retention credit. That's one example. Another example is someone who is going gangbusters and hired a whole bunch more people this year and has really geared up, but they're not a new business. They were operating last year and they're not a seasonal employer. That calculation doesn't really help them. It is possible, although I haven't run the numbers on any real life scenarios where it's happened yet, where the employee retention credit could work better there. So it's not something we're going to use a lot, but we definitely need to be aware of it. And then the other option, and I think the least desirable, to some extent, is the delay of payment of employer payroll taxes. You can do this, but you need to remember that you cannot delay payroll if you have forgiveness in a PPP loan for the same period. So you just need to be aware of that. I want to real quickly talk through net operating losses. There's a special rule for 18, 19, and 20 where we get to carry back to each of the 5 taxable years preceding the taxable year of loss. Yes, we can carry back 100%. Special rules for REITs and life insurance, so be aware of that. Special rule for Section 965 if you do foreign stuff. Hello, amended returns back to 2013. How many of you got rid of your files going that far back? I hope your answer is not you if you had operating losses that could go back to 13. So going to be interesting. My estimation is that for every 100 returns I do over the next few months, I'm going to be doing 10 amended returns. We're going to talk about some other cases where amendments make sense. And that's on corporate AMT. So corporate AMT was repealed in the Tax Cuts and Jobs Act. Most of us know that, I hope. Those credits, if we still had credits, were claimable in 18 through 20 and then fully refundable in 21. Well, now we have an accelerated credit to 18 and 19, and you could even claim the entire credit in 18. Hello, we need to amend some returns, right? That too is going to create some amended returns. And then we have the modification of limitation on business interest, where we have a special rule for taxable years in 19 and 20 only. These rules get a little bit weird, but this is related to 163J. If you happen to know what I'm talking about when I say 163J jail, then you're probably a code nerd like I am, but I don't have time to explain it. But the bottom line is we changed the 30% limitation to 50% of our ATI, or our adjusted taxable income. Some of you are saying, what on earth is adjusted taxable income? Because it was not a term that existed prior to TCJA. TCJA gave us a new term of art, adjusted taxable income, and it is basically EBITDA, which of course is earnings before interest, taxes, depreciation, and amortization. That is essentially what ATI is. And the taxpayer can elect to use ATI from 2019 in 2020. So I think this is going to be pretty helpful to us because we're going to see quite a few taxpayers who have a lower adjusted taxable income in 2020 because of all this that's going on, right? The economy's tanking. However, partnerships, they have special rules, of course, right? So partnerships are only changed for 2020. They do not get to use this in 2019. And they can elect out or opt out as well. Let's talk about QIP, or Qualified Improvement Property. Quick background, TCJA just plain goofed this up, did not properly assign the life, and we've been needing a technical correction since. So QIP was subject to 39 years or 40 in some cases. And so this meant no bonus depreciation. Pretty big deal. We got a technical fix. This is now back to a 15-year life or 180 months as it should be. And so now we get 100% bonus depreciation, and it is effective back to the effective date of TCJA. Hello, we may have some amendments here, or can we make an adjustment? Well, we need some guidance, right? Is it section 418 or 481? I'm drawing a blank. It's one of the two. But can we make an adjustment here? We're going to need some guidance before we can answer that. And with that, we're going to go ahead and launch another polling question, and then we're going to dive into some additional questions here. So this polling question, a new NOL provision may require amendments back to 2013. True or false?
All right, Knox, there's been a question that I was asked. I guess I have to clear up. Why am I in a t-shirt and tie? So just a quick note for everybody. I have been doing a series of YouTube videos as all this mess with COVID-19 has occurred, called the Tax Tie Guy, all one word, geared towards non-tax professionals. I do a lot of CPE classes, especially on collection work for tax professionals, but I've been doing those lately, trying to help the crew out there who don't understand taxes every day like us, and answering those questions. So I thought I'd keep in uniform for this one, even though the Tax Tie Guy isn't necessarily for our loving audience. So that is why I'm doing that. And asking what's in my cup, sorry guys, it's just hot tea. When you're talking a lot, you need something to keep things rolling.
All right. We do have a poll open. I'm going to close it really quickly. It is a new NOL provision may require amendments back to 2013. True or false? Hey, I'm going to get over 90% on something I taught, Vaughn. Yay, we're going to close it. Well, we only have 1,000 responses. We need some other people to pop in here. Here we go. In 5, 4, 3, 2, 1. And I'm going to throw a bonus polling question in. that is just helpful to us, but it's a bonus in case you missed one along the way and you want to catch one. This webinar has been super helpful, moderately helpful, a good review, or a waste of my time. So if you will answer that for us, that's just helpful for us. And with that, Vaughn, you want to look through some Q&A. I'm guessing you've been doing that while I went through the last part. Throw me some questions. Throw yourself some questions. Let's dive in.
We have a lot. So let's, all right. Well, one thing came out, RMD. If we can give a little more detail on the RMD rule change.
Yeah, so required minimum distributions are completely waived for 2020. That's the short answer. We do not have to do RMDs at all in 2020. Was there a more specific question than that, or?
I just asked if we could cover that in a little more detail, in which we did.
Yeah, so if there's a more specific question, ask away, but that's the short answer. You don't have to do them in 2020 at all.
Carrie out there is asking, how does this affect the single member S corporation owner? Carrie, I hope that single member S corp owner is on some kind of reasonable salary, and that's where your application could be on your payroll. Thoughts on that?
100% agree. So yeah, we pretty much covered that, right? S corps, single member S corps should be on reasonable comp. Bottom line. If you're not, you have bigger issues. And you potentially have some other liability in other places. So yeah, you should be on reasonable comp. And bottom line is the government is helping cover people who are employed. The government is helping people who are getting paid. So the only reason you would not be on reasonable comp is if the S corp was not profitable enough to pay you. And if the S corp is not profitable enough to pay you, then there are no dividends either. And so it's all a non-issue.
Still flipping through some of these. We had a lot of R&D, so I'm scrolling through all those. Are farmers eligible for the $10,000 grant or SBA EIDL?
Yes, I see nothing that says they are not. There is nothing to indicate that they are not. So my answer is yes.
Do you have to account for how you spent the $10,000 grant if that's all you apply for? That's a no.
No, that's a yes.
You have to account for, oh, I'm sorry, thank you. This is why we do it together.
Yep, that is an absolute yes.
What I was thinking in my mind, but you still have to spend it on the appropriate things. Thank you for the clarification. After 2 hours, you're here for me as well. Is there a way to go back and cancel the $10,000 grant if you've applied for the PPP loan?
So the short answer there is no. So if you get the 10,000, but you can roll it into the PPP, and I'm pretty sure you're going to be able to roll it in like I suggested. You just need to make sure you don't spend it outside of the 8-week period, or you're going to end up with some that's not forgivable.
Here's an interesting one. If you have a current employee that you would like to terminate for cause, how does that affect the PPP?
So the short answer is you're allowed to have a 25% reduction in pay, but no more, and still be okay. So as long as you are, so that's the official answer. Now, the non-official answer is their hope is that you're going to replace that person with another employee, right? We need to get people employed. That's the whole point of this liquidity. And so their hope is that you're going to hire somebody else and do so quickly. But the short answer is you are allowed to have a 25% variance there.
And just a clarification, Christina was asking, I thought you can't do both loans. So just to be clear, I assume, Christine, you're talking about the PPP loan and the EIDL loan program. You can have both of those and go from there.
Yeah, to clarify that, we can have both, but you cannot have both for the same purpose. So, for example, if I'm covering my payroll during this 8-week period out of PPP, then I can't, also say the EIDL is for that purpose. That EIDL has to be for another purpose, right? So maybe I'm covering out of the EIDL some other things or a different period.
This is an interesting one, and I think it probably has some more reach than just this situation. But for unemployment, this tax professional only does tax resolution. And with the IRS closed up, there's nothing I can be doing right now. Obviously, I'm able to telework, but there isn't work to do. Does that really mean I'm not eligible for unemployment? But I think you'd be eligible for the grant and or the PPP. Thoughts on that, Knox?
Well, I'm not sure I buy the premise. So there's my first thought. So, and Vaughn, you may want to speak more to that. You happen to be in a practice that does nothing but resolution. So do you?
I do both. Actually, I do both. I have two separate companies that do. One does resolution only, and one that does taxes and accounting. I'll say in my situation, since we specialize in high dollar, 50, 100,000 and above, I mostly deal with revenue officers, and they're all still working. So for those cases, I'm not nearly as busy as I was as this started, and I'll see that downturn here soon. I still have some work I'm doing and getting paid for. How long that'll continue, I don't know. But I don't know why you wouldn't qualify in this situation, since you're a business, to apply for the grant and or the PPP loan to help you operate.
Yep, absolutely. So, yeah, that's the short answer. And you could also, that's probably the best answer. I mean, the PPP loan is going to be best in most cases. There are some scenarios in which it's not the right answer, but the PPP loan is going to be the best for most people in most cases. And for most people in most cases who have serious liquidity issues, I would encourage both the disaster loan and the PPP. Now, for myself, I'm not doing both. I'm not as impacted. Thankfully, I happen to be in professions where I'm still getting paid, right? I still have plenty of work to do. You could argue I don't get enough sleep. You could win that argument that I don't get enough sleep. So
you're doing the grant, but not the PPP. Is that?
I'm doing the $10,000 grant because I don't really see any reason not to.
Right.
I'm probably not going to do the PPP, and I mean I would qualify, but honestly, I don't think. Now, let me rephrase that. I also happen to pastor a church, and we are going to do the PPP at the church. So I am doing it there, although I don't own the church, obviously. But in terms of my tax office, no, I'm going to do the $10,000 grant. That's enough, because I don't feel right, honestly, taking more than that ethically, because I'm fine. I'm blessed. So, but I don't mind taking the 10,000, and I can definitely use that for the affected things, and I think that's reasonable. But I don't need to do more than that.
What is there a time frame for spending the grant, the emergency grant, on correct expenses? I'm not aware of a time frame on the 10,000. Are you?
Yeah, I don't think we have seen a specific time. It's got to be in the law. I need to look that up. I don't remember, but I'm going to look it up right now, because it does not make sense to me that there wouldn't be.
Right.
So I am going to look it up. That is section. Anybody remember the section? I actually have it in my notes. It's 1110.
And then Karen's also following up with are there specifics of how business will report how they spent the 10,000? I haven't seen that yet either. Have you?
So the covered period is January 31st through December 31st of 2020.
Okay.
For the EIDL grant. And so that money can actually be spent anytime during 2020. So you could even use it to pay off debt that, or bills that you cannot pay, debt that you took during the first quarter of 2020. So it's a pretty liberal use there. Mm-hmm. For the emergency grant, but any advance that's provided can be used for any allowable purpose within the calendar year 2020.
And have you seen any specifics on how you're going to have to report how you spent the 10,000? I haven't. I think there's more guidance on the PPP somewhat than there is on the 10,000.
Yeah, we have not seen that specific guidance, but I feel confident that, well, first of all, we made a certification when we took it out. So we made a certification, and we perjure ourselves if we don't spend it that way, because we made a certification when we filled out the application that said that we promised to use it for these purposes.
Correct.
It's possible that they leave it at that, but I don't think that they will, because they're going to follow up. An SBA loan officer is going to follow up with everyone who made that application to see if they want to do a loan. And I think that my anticipation is that as a part of that follow-up, they're going to be talking about this $10,000 grant and how you spent that money.
Ruth's asking what's included in utilities. I take it under the PPP loan. There has been no clarification on what types of utilities, if there's any limitations, phone versus electric. It just says utilities, unless you've seen something, Knox.
No, I agree with that. And I think the definition actually is going to be the same there. So I think, even internet is going to count on that. I think it's all going to be okay.
Is the $10,000 loan forgivable on its own, or do you have to apply for the PPP loan as well? The answer is those are two completely separate things. You do not have to apply for the PPP to have any impact on the $10,000 grant. Is there any issue? Nice job, Christy. Is there any issue with rents paid to another entity owned by the same owners? I haven't seen anything. I can't hear you. I can't hear you.
Oh, I'm muted. That's not helpful.
So do we want to try that one again?
What was I answering? I don't even remember. How long was I talking?
Was for if you own your own office, I'll see if I can find it again. But
oh yeah. The question was related entity, basically.
Yeah, related
Can I
entity.
pay a related entity? And the short answer there, and this is my opinion. My opinion is that if you were already had a history of doing that, then you're going to be just fine. But if you are suddenly starting to do that during this period, I do not think that's going to be okay.
I would agree with that 100%. Lost my place in the question, so I'm just going to I'll just pick up some new ones. Does the 5-year NOL carryback apply to individuals as well as corporations?
Short answer is yes. Longer answer, well, I'm just going to leave it at yes. There is a longer answer, but I'll leave it at yes.
Who are the lenders for the PPP? Those are SBA approved lenders who are going to participate. So there is some concern out there. Some of the bigger banks yesterday came out and they're not sure if they're going to participate in this and not. They're worried about some liability issues. So you need to identify the lenders who are participating. It's not all of them. Knox?
Yeah, I agree. They are going to, their intention is to bring in every bank that applies. So part of what you need to realize is that the entire SBA program was, X percentage, and now it is going to be significantly higher. To give you an idea, it is going to be about 9 times larger on what they're expected to expend in 2020 versus what they expended in 2019. So the assumption is not that they're going to be able to do so with the same level of facility or number of banks, right? They're going to need more banks. And so initially it is the ones that are already SBA approved, but new banks that want to become SBA approved, I have seen the guidance on that, and it's very, very liberal. They're even giving delegated underwriting to brand new banks, which SBA never historically does. But for the PPP, they are giving delegated underwriting because the underwriting is so simple. The underwriting is essentially verify that the company was in business on February 15th of 2020, A, and B, verify what the average monthly payroll is. That's the entire underwriting right there. Those two things. Those are the only two guidelines in the underwriting. So they have to, and there's a third, and that's comply with the Bank Secrecy Act. So they have to, Patriot Act and all that stuff. So that's all that they have to do. It's really, really simple underwriting. Really, really simple underwriting. So someone is saying they don't see the poster in the handouts. It's in there. I guess I'll open up the handouts and find it for you.
Someone found the page number, but it's near the end.
Oh, awesome. If someone found it, if you open the bookmarks, I put bookmarks in the handouts intentionally so that you could find things because it's large, right? So if you open the bookmarks, then you should be able to find things in here much, much easier. But it is entitled FFCRA Poster, and it's right after the Form 7200. It's on page 136 of 200 in the handouts.
Skeeter out there is asking, on the site, do you have to apply for EIDL to request the grant? So Skeeter, yes, the grant is part of EIDL. It's the initial application process, but you do not have to take the full the EIDL program. If you don't want to, you could just do the grant. What about someone that was a sole proprietor in 19 and has a new S Corp in 2020, but have not paid themselves a salary yet? Millie, I think you found you're going to be tough on that one. I don't think there's a good answer for you. Knox?
Yeah, I think you're going to be an employee retention credit person because you're going to start paying yourself and get the employee retention credit. The other side of that is the EIDL grant. You can definitely do that $10,000 grant and use that towards payroll, right? So you can utilize both of those for different periods, and but you're probably not going to qualify for the PPP.
Still skimming through. We got lots and lots here.
Someone is asking about charges. There will be no charges to the end user, to the taxpayer, to the consumer on these loans. The SBA is giving an origination fee of 5% to the lender in most cases, but anyway, that's what it is. Someone else is asking, what are conscionable fees? So you cannot charge a fee to help your client with the PPP. You can get set up as an agent, and depending on the size of the ultimate loan, you get some percentage back. It's like 1%. Personally, I don't care. I just want to help my clients, right? I think that my clients at this point appreciate the fact that we help them through this, and they remember that, and they become loyal clients, and I'm much more interested in that than being some shyster on the internet looking for a quick $2,500. So you got Knox's personal opinion.
Paul, Knox, we got an old friend of ours, Paul LaMonica, asking a question. He's a great instructor. Can an S Corp shareholder employee collect unemployment? Good question, Paul.
And the answer to that is yes, they can. They are specifically included.
What can our college student with little income do to get the stimulus? So I believe they're asking about the check. If that college student was claimed as a dependent on their parents' return, they're not getting a check. If they were not claimed and they didn't have a reason to file because they didn't have sufficient income, now they can go ahead and still file, and then they'd be eligible for the check. But if they've been claimed as a dependent, they're out of luck.
Agree. I'm seeing actually several questions, and we mostly answered this, but several questions about S Corp owners who are not on payroll.
Yeah.
Folks, the law is clear. They need to be on payroll. They need to be paying reasonable comp. Use this as a teaching moment with your clients to say, look, just because you choose to break the law does not mean you should get the benefit of having broken the law. Now, that's my personal opinion. Having said that, they could take the EIDL grant for $10,000, and they could use that, start paying payroll, and do it the right way. They could also qualify for the retention credit if they start doing payroll. So there are still some options for them, but the PPP is not going to be an option for them if they were not on payroll.
I see a shout out that the poster is page 137. I think I've seen that more than once. So if you're not using the bookmark. Marjorie's asking, I am a tax season temporary independent contractor, and while my income is tracked last year until last week, I will earn at least $10,000 less than 18. Would I be eligible as that independent contractor for the $10,000 grant to pay myself? I can't see why not. Knox, thoughts?
Yeah, I'm sorry. I was actually reading other questions, so I didn't listen to the whole question. But
sure I'm not missing that one because I know that's I think every independent contractor is eligible for the $10,000 grant.
Yes. I mean, the short answer is yes, assuming they can use it for the appropriate expenses. So that's the question, right? Not every independent contractor even has $10,000 in expenses. So, that's the thing. You have to be able to certify that you're going to use it for the appropriate expenses. We're not talking about the MLM person here. Right.
Chris is asking a question on the pending application for the PPP. It says number of jobs, and my impression was representing how many staff members that you're going to be doing. He's asking, does that mean full-time employees or total W-2s?
So it's FTEs is what it's looking for.
The $1,200 check, is this considered a tax credit, rebate? What's going to be on 2020 when the time comes?
It is not taxable.
Correct.
I think that's what they're getting at.
I think so too. So there's not going to be an I saw one question earlier. It's not an advance on your refund for 2020. It is a separate payment that is not taxable income.
So I'm seeing a few questions here, and there's been some confusion. I think some other CE and CPE providers have given some bad information, so I will take it.
Please.
And the question is about the employee who is making more than $100,000.
Okay.
So, the employee that's making more than $100,000, do they get excluded all the way around, or is only the amount above $100,000 excluded? The correct answer is that only the amount above $100,000 is excluded. I have seen some other CE and CPE providers say that's a different answer than I just gave, but I'm telling you what is the correct answer. And actually that came out in the guidance this week. And so you will notice on the application, it pretty clearly says that, to be honest. But if you just think about the logic of it, that's what makes sense, right? If you don't include it, then your 2.5 times of what you're doing isn't going to match the 8 weeks. So, just think logically about it. If it's a highly compensated employee, then you're going to have a situation in which you're going to count the 100,000 plus the pro rata portion of the health insurance, right? You get to count that as well. So it's the 100,000 plus the pro rata portion. Somebody else had a question, is the pro rata portion included in the 100,000? No, it's 100,000 plus that amount. Jeff, sorry that I disagree with you on that. The application is actually quite clear, and the statute is ambiguous. And logic also speaks on this. So I'm pretty sure what I'm saying is correct.
There's more than one question talking about how to use any of these funds to pay mortgage and utilities in your home office. Do you want to take a shot at that one?
Yeah, don't.
Yeah, I wouldn't think so either. I think that's an area you do not want to go in, and I suspect you'll get pushback when the time comes.
Yeah, I wouldn't do that.
I've been telling clients not to do that as well.
Yeah, so a couple people are asking, can you leave? Absolutely. We're beyond the 2 hours. This is just free bonus Q&A. Obviously, I guess the whole thing is a free bonus, right? Because the whole thing is free. But this is a bonus. If you need to leave, you're over the 100 minutes. Right. You've answered the polling questions. You're good to go.
Well, on that note too, Knox, I see some feedback on the event itself, and everybody's appreciated, which we love to hear. We are planning to start offering some paid CPE in these webinars, not just the two of us, but other people in the Virginia Society of Enrolled Agents. Our goal was to bring this free to everybody from a COVID-19 perspective and help you navigate this, ask questions. We can all work together. But we do intend to build upon this as we all come out of it and offer future CPE. Knox, thoughts on that? Just to follow up.
Yeah, absolutely. So, offering CE or CPE by webinar format is new for the Virginia Society. We've been doing live CE for a long time, obviously, and CPE for that matter. But it's new for us to do webinar format. So we're kind of launching that right now and anticipate doing much more of this over the next few months. So I'm glad to see so many of you that have found value in this. And certainly we will have future options, some of which will be paid and some of which will be free. But obviously, we have to cover overhead as well. So you're going to find good quality at a good price. That's sort of the bottom answer there.
And as for me, I typically hold mo to the collection side, having been taught by an ex-revenue officer who worked the IRS for 28 years. And then he and I worked together for a number of years after that. So we're just trying to help on the Q&A side as we share things. Knox, I know we're 30 minutes over. How many more questions do you think you might want to take? Because I know you've got something later as well.
I do. I teach in another webinar in a little bit. We can give another maybe 5 or 10.
Yeah, that sounds good. And if you want to scroll through, we both do, because there's so many. We'll never get through them all.
So Cheryl just made a comment. She said, you're new to the webinar format. Yours is the best I've seen yet. Good job. We appreciate that. I am not new to doing webinars, but the Virginia Society is new to doing webinars.
As I touch my face, go ahead and keep drinking, Kelly. All right. That was the joke for those of you who weren't on earlier. I got plenty of feedback last week about stop touching my face. You can tell I'm new to this. So I just encourage, if you're starting a drinking game today, or how many times I touch my face. It may be rough on you, but I've tried my best. So, how? I'm still looking. If you see one, you go first. There.
All right, we'll take maybe 2 more questions, and then we're going to close. But before we do that, while you're looking, I do want to mention again, I mentioned this at the beginning, but there may have been some who were not on. In terms of the CE, those are manually processed by the Virginia Society. So, bear with us. You'll get them. IRS guideline says within 90 days. You're going to get them far in advance of that. But they're still working on the ones from last week right now. And obviously, they'll be working on those probably the rest. Our hope is to get those out this week, could spill into next week, and then they'll start working on these. But bear with us. You'll get them. And same on the CPE, right? So the other thing to remember is that, we all have jobs. We all work in tax practices, and we're busy, quite frankly. I slept 4 hours last night. I'm teaching this webinar plus another one today that's new, which means I had to write it as well. And I'm teaching another new one tomorrow, which means, and I haven't written that one yet. So I still got to do that one tonight. So, and I still have a practice. So bear with us, but we're getting all of this done for you. Some people are asking, will the recording include the Q&A? Yes, I have not pressed stop on the record yet. So it will include everything here. And you will get a replay email of this webinar. So if you were here, then yes, you'll get access to the recording. It will be available for those of you who attended to access that recording. Not a problem. Obviously, you don't get to also get CE for that. You get CE for the live, not for the recording. You can't double dip. Duh, right? But anyway, what questions do you have? Go for it, Vaughn.
I got one here that if someone has 2 S-corps with separate employees, can they get 2 separate loans and or grants?
So the short answer to that is yes, but there is a max. So there's an aggregation thing that we are an affiliation deal that we have to look at. And so actually when you fill out the EIDL application, one of the questions that you're going to find on there, or maybe it's the PPP application, or maybe it's both. I don't remember for sure right now, but you're going to find a question on there that asks, are you an owner of any other companies? Basically.
It's on the PPP, Knox. I'm not
PPP.
Sure. See on the grant, but I know I saw the PPP.
Okay. Well, it's going to be on the EIDL. They're going to ask about it as well, but it's definitely on the PPP application. Thanks for clarifying that, Vaughn. I knew I'd seen it in one or the other. And so, yeah, they're going to look at that. And basically, the max employees is where this is going to factor in. So,
I see. Yeah, 500, less
exactly.
than 500.
So they're going to look at the combined amount to get to the 500. So where this is really going to impact is the hedge funds, frankly, or some of the loan sharks that are out there. That's not what I should call them, but some of the guys that come in and they say, "Hey, I'll give you X amount of money, but I want an ownership interest in your company." And now all of a sudden they have a significant percentage of a ton of different companies. They're over their 500. They're going to be out on the PPP. So yeah, that's the way that works. Someone is asking about income taxes on unemployment. Same as always, it's taxable. Yes.
And they're asking in the PPP program, if it's 8 weeks for payroll, do you only get forgiveness on the mortgage and utilities during that same 8-week period? I was taking that as it's got to be the same period.
Yep.
A couple more. You pick one.
Someone's asking, and this happens to have been in the chat, so I shouldn't go to it. I should be looking at the Q&A, but it happens to be right in front of me. How long does the interest accrue on the PPP? Is it until the loan is forgiven or through the 2-year period? So there's no prepayment penalty, which means that you're not going to be charged for the full 2-year period. You're going to be charged until it's paid off. So whatever the balance is, it's pretty simple amortization. All right. Do $100,000 plus employees count towards the headcount calculation? My answer is yes.
Yeah. Are we done? We're calling it?
Yep. All right, guys, we appreciate you. Once again, CE and CPE, those are going out not by Vaughn, not by Knox. The CE is going out by the Virginia Society of Enrolled Agents. The CPE will go out from Tax Practice Pro. Special thanks to John Sheely and the good fine folks over at Tax Practice Pro for helping us out with that. because although the Virginia Society of Enrolled Agents is a NASBA-approved CPE provider, we are not approved for group internet-based translation. We're not approved for live webinars. We're only approved for live in person. So John stepped up to the plate and helped us with that, and I just want to say thank you to John and certainly to Tax Practice Pro for that. I want to thank all of you who are here and say take care and try to get some rest. Take care of yourself. Don't get sick. Stay indoors and be smart. And other than that, I'll take one final question, and that is for service people. What do we put for COGS on the EIDL grant application? And the answer is 0.
I'm going to take one more.
0.
I can't help it. I got to take one more too. And I think a lot of you all are running into this challenge with some of your potentially brand new or smaller business owners. Here we go. Ruth, self-employed beautician, has 0 income because North Carolina has non-essential quarantine. Is her only resource unemployment to replace her own living expenses income? I don't believe so. I think the $10,000 grant comes into play. Thoughts on this?
This is a self-employed person?
Self-employed.
Yeah. The $10,000 grant could come into play. And for that matter, so could PPP.
Yeah. So Ruth, I think it's a great question. I'm sorry we didn't cover that because we should have. I know I should have. That's on me. You've got PPP. You've got the $10,000 grant. And is there any restrictions on unemployment, Knox, if you're doing the others?
Yeah, you can't double dip.
Okay. So, there's a calculation for you. You really need to sit down and run the numbers of whether the unemployment with a $600 benefit and when that expires is potentially better than the $10,000 grant and what your PPP loan might be.
All right. And with that, Vaughn, I think we're going to call it. Thank you all so much for coming and being a part. I hope that this was helpful to you. Hope that you gained something from it. Take care.